tell us how to make things like Jack. When traders tell us how to streamline like Jack. When traders tell us how to streamline like Jack. When traders tell us how to streamline like Jack. When traders tell us how to streamline like Jack. When traders tell us how to streamline like Jack. When traders tell us how to streamline like Jack. When traders tell us how to streamline like Jack. When traders tell us how to streamline like Jack. When traders tell us how to streamline like Jack. When traders tell us how to streamline like Jack. When traders tell us how to streamline like Jack. When traders tell us how to streamline like Jack. When traders tell us how to streamline like Jack.
Welcome to Your First Trade. I'm Scott Connor, a 30-year veteran trader, and it is Friday, March 11th. Now, on our show, first we'll invite in the chart master, Ben Watson. He's going to wrap up what happened this week with the major indices and break down their charts and share with us his takeaways. It's been a volatile week for the markets. All four indices ended lower. Let's hear what the chart master has to say. And after that, I'm going to review the 4 example trades that we put on this week on Your First Trade. And then we're going to join John McNichol. You know him as a contributor across the network. We're going to talk about 2 option strategies, completely separate option strategies, and talk about how they can be used in a complementary fashion by combining both. Interesting takeaways there. And then finally, the last segment, I'm going to wrap up. What are the takeaways from this week in terms of market action, stocks that were in the news, talk about how economic data impacted the markets this week as well. All right, well, let's start from the top and bring in the the whole Russian conflict started, it was February 24th that the market hit lows. Now, none of those indices have gone below that point. Ben, is that going to be a focal point next week to see if the market can hold those lows?
Oh, it sure is, because if we can hold the lows that we put in this week, that becomes a new higher low. And if we couple that with a higher high, that may begin a climb for these indices back towards some of those previous highs that we've seen over the course of last year and early part of this year.
Okay, Ben, we're going to have to wrap it up there. Thanks for helping us get some good perspective on what the markets did this week and what to watch out again for next week. All right, thanks again, Ben. Have a great weekend. We'll see you on Monday. All right, now let's turn our attention back to the Thinkorswim platform. I'm going to go straight to the Monitor tab on Thinkorswim and take a look at some of the example trades we put on this week. Let's start with Monday. The first stock we looked at was CPB, Campbell's Soup, and they had earnings, so we did a short-term option strategy. So follow along with me here. I'm going to click on Campbell's Soup. Let's take a look at what that trade was. And as you can see here, we sold the 48.49 call spread, right? So in other words, we didn't want to see the stock go much higher after earnings. Well, take a look at where the stock finished today. On expiration Friday, when the bell rang, it was trading at $42.17. Almost, what, $6 lower than our strike. So those options expired out of the money. And of course, we realized the maximum gain on that one, which was 20 cents, so about $20 minus any transaction costs. Then on Tuesday, we looked at JD. Now, JD, what we did is we put in an option strategy to sell a put spread down at, I think, the 53.54 level. Now, I think we put in about 19 or 20 cents. Now, that did not get filled because the stock rallied the next day, and so it just didn't happen. So what I did is I was looking to see that if we raised our strikes up to 55.56 from that 53.54 level, would we have had a better chance of getting filled at that price close to 20 cents? So I put that order in just to see what would happen. And then here's what's interesting. I left it in overnight. It got filled the next morning because the stock obviously went down after the earnings, and that got filled at 80 cents. So it's a $1 wide spread. So if you're wondering, well, what is this trade doing in here? Well, it was the 55.56 put spread, and look where the stock ended up, 48. So it not only went through those strikes, it continued to go lower, and so this one took its maximum loss, which was 20 cents, because this spread was sold for 80 cents, and then it went to its full value of $1. So again, when you're selling a spread, you don't want it to go to its full value, you want it to go to zero. It went to its full value of $1 minus 80 cents. So that was a net loss on this particular one of 20 cents or $20 plus any commissions. All right, so that was that one. Again, not too bad there, but our original trade, remember, if you were following us, did not get filled. It never came near our price. All right, let's look at Ulta, ULTA. Let me highlight that one next. Now, this stock came out with earnings again, and we were looking to put on a strategy that would align with someone who thought that the stock would do okay, or actually maybe even bullish after earnings were announced, but just not go down. All right, that's basically what this trade didn't want to see. So let me highlight what we did. We sold the 347.5, 345 put spread, $2.50 wide put spread down below. Well, they came out with earnings, and sure enough, stock acted very well. It rallied significantly and closed here, even though today it was down $10. Let's see if that's exactly right. Yeah, down $10, still closed at 368, well above 347. So even though the stock came down today with the markets, it did rally quite a bit after the earnings were announced. So selling that put spread, it expired out of the money on the closing bell today. We sold that for 90 cents, so that would be 90 cents times 100. That's a $90 credit, which was realized here, of course, since both of those options expired, worthless, minus, of course, any transaction costs. So again, that one worked out pretty well. And then finally, we have a couple seconds left. Let's look at what we did in Tesla. Now, Tesla was not based around earnings. This one has still a couple weeks to go. It's, as you can see, 21 days till expiration. But this morning, stock opened around the 850 level, which was good because we were looking to sell a call spread up at the 930 level. Now, you might be thinking that's quite a bit above 850 where it opened today. Well, unfortunately, it looks we did get filled on that one, and that we were trying to sell that spread for somewhere between $1.50, $2. Now, it did get filled around the $2 level, but then the stock proceeded to move lower today, down significantly, all the way down to 800. As a matter of fact, I think closed just a little bit below that, 795. So right now, this trade is looking pretty good because the stock did drop quite a bit, significantly, after that trade was put on. So we may look at this next week and decide if we want to hold it or perhaps look to potentially closing it because the stock has gone in the direction of this trade. All right, that's going to do it for our example trades. Don't forget, we've got a lot more names next week, and we'll putting those together as well. Now, coming up next, I'm joining John McNichol. We're going to talk about alternating two common option strategies. You don't want to miss this. See how these two can potentially fit together. We'll be back after this short break.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
90 minutes after the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Welcome back to Your First Trade. I'm Scott Connor. Now let's talk options. Today, we're going to consider two popular option strategies and explore how they can be potentially used in a complementary fashion over time. Now, we'll start with an option strategy that generates a credit and potentially results in being long stock. Then, we're going to examine, if you will, a strategy that generates a credit, again, while assuming the obligation of selling that stock at a potential higher price. Now, joining me today to discuss how these two strategies can be used in combination is Your First Trade contributor, John McNichol. John, thanks for joining us here to close out the week. I thought we'd look at these two strategies and talk about how they can potentially be used together. Again, a lot of people are probably aware of the different strategies, but maybe don't think out as far as like how could they be used together. So maybe let's define what these two strategies are first, John, just to kick things off.
Sure, Scott. So these strategies are referred to as cash-secured puts and covered calls. Basically, these are two strategies that can complement each other in how one looks to buy a stock at a lower price, while the other looks at potentially to sell those shares at a higher price. It's important to remember that both option strategies begin with selling options and generate credits.
Got it. All right. So both of these are started by selling options and generating a credit. Got it. And remember that credit is credited to the account. No matter what happens, that credit is received into the account. Then the question becomes, all right, does this strategy end up owning stock? And if it does, then this complementary strategy might also end up in selling stock, hopefully at a higher price. But again, let's start with the first strategy. Now, you mentioned short puts, or sometimes referred to as cash secured puts, right, John?
Yeah, that's right, Scott. So let's assume a trader has no position in a stock and is interested in possibly owning at least 100 shares. So by selling a put short at a strike price that is lower than the current price, the trader takes on the obligation of buying the stock at that lower strike price. The trader collects a credit, and on expiration day will be automatically assigned to buy the stock if that price finishes below the below the strike price.
Got it. So when you sell a put, you're taking on the obligation of potentially buying that stock at that strike price, right? And we're talking about an out-of-the-money put, right? So tell you what, let me just run through this real quick with an example. I'm going to use Meta Platforms, otherwise known as FB, Facebook. Again, that's the parent of Facebook. John, take a look at this chart with me. I'm going right back to Thinkorswim platform. And let's just say a trader, again, this is just a pure example, is looking at Meta Platforms, saying that this stock just a few months ago, 6 months ago, was trading at 384, John. And now they're seeing it trading at like 186, right? So what, $180 lower than where it was. And so now they're thinking, well, this stock's come down a lot in value. And if you kind of look at where this stock is, in terms of price, when you compare its price to what it's earned over the last 12 months, it has what's called a PE ratio of 13, right? So again, there might be some people looking at it saying, okay, well, maybe I'm interested in potentially buying. So let me go to the trade tab, and we'll tell you what we'll do. We'll go out 4 weeks, all right, about a month, and we can see the stock is, like we said, trading right here about 185. Now, what you were talking about is selling the put would be saying something like that, okay, well, if the stock gets down to, John, I'm going to go like $15 lower, right? So again, this is still four weeks out. And highlight that put. Now, if someone were to sell that put, and I'm going to go through the process, sell the 170 put, they would collect, I'm just going to make it easy, $3.50. That's a $350 credit, right? But what happens when you sell that put? If that's filled, they take on the obligation of potentially buying that stock at $170, the strike price value. So again, I want to walk through an example of how this one would work. Now, let's talk about the potential outcomes. What happens if the stock ends up, 4 weeks from now in different places? Like maybe let's start off with what happens if the stock price ends up, above this strike price of 170, John.
Yeah, so what that'll deal is that will basically be an assignment there. So, if someone is basically still bullish on that stock, did you say above or below? Above, yeah. So, yeah, it would expire worthless. Yeah, it would expire worthless. That's correct. Yeah. So, and if in that case, if we're still bullish in that process, we can have the opportunity to go ahead and basically sell another put again. In this example, selling another out-of-the-money put. Got it. All right. So there, that makes sense. So if this 170 put was sold, and in 28 days from now, the stock was still above that, if they still had that position when the bell rang, there would be no automatic exercise or assignment. And yeah, they would just obviously you'd keep the credit, what was it, $3.50, the $350. And then, yeah, like you said, they could maybe just sort of recalibrate and think about using the same kind of strategy again, looking down the road. Now, let's talk about the other side of the coin, John. What happens if the stock does drop down to 170, right? And now we're approaching expiration and the stock is here just a little bit below 170. Then what, John? Yeah, well, so we have an obligation there. And so therefore, if it goes below that strike, that would result in an assignment. So essentially, we would be put 100 shares of that stock at that strike price, but we would be able to keep that premium there. Got it. All right. So now we know the two scenarios where the stock closes. Very important, and you always have to keep in mind of that obligation you talked about. Now, let's go to the next one, the next strategy, because again, we're going to assume that, let's say they assume that they ended up buying 100 shares down at 170. Let's talk about the second one, the covered call. Yeah, Scott. So in the first scenario, we were selling premium to generate income on stock that we potentially want to own. In this scenario, we can sell some premium against stock that we may be prepared to sell. So since those 100 shares are now owned, one can short a call and could be sold at a strike price that is higher than that stock assignment price. This would result in a covered call. So what the call seller does is they're going to take on an obligation now of selling that long stock at that higher strike price. Now remember, a credit is received when the call is sold. Then, as with the original short put, depending on whether the stock finishes above or below that call strike price at expiration, an automatic assignment would be determined.
Got it. All right. So assuming that they got assigned on the put, the original put at 170, now they own the stock. They bought 100 shares at 170, and let's say it's maybe trading just maybe a little below 170, and then they sell a call out of the money. Now, if they sold a call out of the money, that's about the same distance away the put was. Let's say maybe $15 higher, $20 higher. They, and they went out a month. Maybe they'd be looking to get a credit again, somewhere around $3. Collect the $300 credit, or that gets credited to the account. But now they have the obligation of selling those shares up at that, let's see, if they bought it at 170, maybe 185. Maybe, again, they'll use that strike. Again, I'm just picking a random one. But interesting. Now, if the stock doesn't get up above that or doesn't below it, let's cover that real quick. What can happen here with the two outcomes of the covered call, John?
Sure. So if the price does not go above that strike price, that option would expire worthless. The trader would be able to hold onto that stock, and guess what? They can go ahead and sell another out of the money call and generate some additional premium there. Now, if the price was to go ahead and finish above that strike price, then the call would typically automatically be assigned, meaning that you would be selling that stock. It would be called away at that assigned strike price.
Got it. So in our example, if the stock went down, they sold the put, went down to 170. They ended up owning 100 shares. Then they sold the 185 call, and let's just say for our example, it goes up to 185. Then they get called away or they get assigned. And now they have no position, right? Kind of bought the stock lower, sold it higher. Now that would be the ideal outcome, right? But again, if that did happen, John, maybe they could look to just start the whole process over again if they were still bullish on the stock and pick a strike to sell a put that's out of the money again and start that process over. And then now that we see how that potential relationship, now there's no guarantee the stock's going to go lower, you buy it, and then it goes higher and you sell it. But again, that is obviously the desired outcome. John, we're out of time. We're going to have to wrap it up here. But great look at how two option strategies can potentially be used in a complementary way. John, have a great weekend. We'll see you again on your first trade. All right, stay with us. We're going to take a short break and then come back and wrap up the action on the market today. Talk about some stocks that were on the move. We'll be back after this short break.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watchlists from the Market Watch tab. After creating a watchlist, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watchlist. From the Scan tab, right-click a security and then Add to Watchlist. And that's how you make a watchlist. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Welcome back to Your First Trade. I'm Scott Connor. Now it's time for the wrap. Take a look at what happened in the markets on this Friday, March 11th. Well, all four U.S. indices finished the week down on the day across the board. All four indices based on the Ukraine talks. They opened up actually unchanged, a little bit higher. Markets showed a little bit of strength here on the opening, but just couldn't hold. They stalled out, couldn't hold on to gains, and they sort of drifted lower into the close. Now, once again, the markets did give up their gains, and this has kind of been the theme all week long. It's been very difficult for the market to hold on to those gains. You can see all four indices down today between about 0.7% to 2%. All right, let's talk a little bit about some of the commodities that we watched so closely this week because of their close ties to what they mean in terms of inflation. Let's start off by looking at oil /CL. It was up $3 today, back up to 109, moving just a little bit higher. Natural gas also moving higher today, up 3% to 4.78. Now, again, these are energy commodities that definitely factor into it. We all have to pay and obviously influence inflation. Now, finally, we also were watching /CW. That's wheat. That had been moving up quite a bit in the last few weeks. Today, it had 2 days where I started to move a little bit lower. That was encouraging from the inflation standpoint. But again, today, kind of gaining some momentum back to the upside. Finally, let's look at VIX, or the fear index, the VIX. And what did that do? Well, that was actually on the day up slightly, about 52 cents. Not a big move, but look at where it's holding. It's holding above that 30. Now that now makes, what, 2.5 weeks plus that VIX has stayed above the 30 level. So the short-term fear continues. All right, now let's turn our attention to some stocks and some sectors. Let's start off with where the weakness was today. Well, it was in the main three FANG sectors, if you will. And what are those? Information technology, consumer discretion, and communication services. Definitely saw some weakness in those sectors. Now, one of the reasons that we saw the weakness in those sectors are two particular stocks that were on the move today to the downside. Let's take a look at what those were. Number one, we talked about Tesla here a little bit earlier, definitely showing some weakness today. Netflix, another one that was weak today, down 4.6%. Again, these are the big FANG names that are widely held, widely followed, but they've been under pressure all week, and we saw a continuation of that as the week went on. Now, let's talk a little bit about some economic data we saw today. Well, consumer sentiment did come out this week, and it is for the month of March. So this is a recent data point, and unfortunately, it wasn't very encouraging. The numbers came in just a little bit below what was expected. They came in at 59.7. Didn't miss the expectations, and I think what's important to do is put this in perspective. It was down to a decade low. So last time we saw levels this low in consumer sentiment, that 59.7, was in 2011. So again, not a good takeaway there. What else do we want to take a look at in terms of the S&P 500? What I thought we'd do here to wrap up the week is just take a quick look at, we know it was a down week, we know the markets are struggling to hold gains, but where do we stand year to date since January 1? Let's take a look at how the four major indices sit right here at the end of this week. The S&P 500 is now down 11.5%. The Dow Jones is down just a little bit over the 9% mark. NASDAQ down about the 18% mark, and the Russell down about 11.5%, 12%. So now you can see this week versus where we stand for the year, and this is going to be important going forward. Let's see if we can hold those lower levels that we saw a couple weeks ago. That could be encouraging for markets. That's going to do it for us here today on Your First Trade. Thanks for joining us. Don't forget, we'll be back Monday at 4:30 Eastern Time to look for more example trades. Keep close tabs on the market. Have a great weekend. We'll see you then.
Good morning. We are 90 minutes into the trading day. Welcome to Trading 360. I'm Nicole Petalides, live in New York City. Thanks for being with us. We have the markets here. Mixed bag, down week though. Again, when you take a look at the major averages, you will see a couple of up arrows here, and that includes the Dow Jones Industrial Average gaining 236 points at 33,410. The S&P 500 also a winner, up 12 points at 4272. The NASDAQ, though, down 19 at 13,576, and the Russell is down 7 at 2,005. Some of the market movers making news this morning. Rivian lower reported a wider than expected loss. The EV maker said supply chain issues would limit its factory output to just 25,000 vehicles in 2022. The company only had 909 deliveries last quarter. DocuSign tumbling after issuing disappointing guidance. It beat on the top and bottom lines, but full year guidance was below Wall Street estimates. The stock has now wiped out all of its pandemic era gains after a second straight disappointing report. Deere is higher after Wells Fargo initiated coverage with an overweight rating and a $455 price target. The analyst said the heavy equipment maker continues to distance itself from the rest of the group by embracing secular tailwinds around technology and sustainability. JP Morgan downgraded Chevron to underweight from neutral and maintained its $169 price target. The analyst said its valuation looks increasingly full, and the shares now offer the least upside in the group. You got to take a look here at the futures products. We'll take a look right now. You can see the VIX. I think the VIX is very interesting because it's below 30. Really, about a week ago, that's where the last time we really saw it hovering below 30. Crude oil, 109 and change the barrel. It's up 3%. Gold is at $19.85 a troy ounce, down slightly. Dow, you can see the dollar index futures up slightly at 98.74, and Bitcoin, 39,040. Let's get some insights on the news shaping the markets, and for that we welcome in John Lear, Chief Economist, Morning Consult. Thank you so much, John, for being with us. So I think it's important that we discuss the economic backdrop here. We've gotten in a lot of economic prints, including that CPI print. Tell me your thoughts as you've gotten in more and more data.
Yeah, thanks for having me on, Nicole. So I think the biggest thing right now that concerns me is this inflation front. You mentioned yesterday the 7.9% year-over-year CPI print. And on a monthly basis, we had an 8 percentage point increase from January to February. And so we're not slowing down. In fact, inflation accelerated slightly from January to February. It continues to spread beyond some of these pandemic-affected sectors. We're seeing it hit gas prices, obviously, but it's also working its way into to food prices as well. Travel and hospitality was severely affected. So I think the picture right now is one of rising price pressures, really diminishing consumers' purchasing power, and also starting to erode their confidence.
And so now when you think about the consumer, right, because we got the sentiment, we've seen the spending, the consumer is such a key part of this picture going forward for GDP and what happens to our economy, right?
Yeah, so it's 70% of the U.S. economy, U.S. GDP. I think there are two things to keep in mind here, which is, first of all, the operative metric is not just inflation, but it's really purchasing power. And it's looking at that difference between inflation and wage growth. And I think what we saw yesterday was that wage growth was essentially flat in February. And so wage growth continues. Average hourly earnings are trying to keep pace with inflation, but they're struggling, and slowly but surely that purchasing power is being eroded. And what you're likely to see is a lot of reallocation going on within consumers' spending baskets away from some of the high-end discretionary items towards more lower cost staples.
Okay, so they are feeling the pinch, no doubt. And so the Fed has a very challenging road ahead, to say the least, right?
Couldn't really be the worst time for the Fed to have to start raising interest rates. Not only is there this, concern around inflation, but then we have the elevated uncertainty surrounding the Ukraine war. And if you look historically, the Fed has historically been able to decrease interest rates surrounding periods of military conflict and geopolitical tension. They don't have that luxury right now. And I think, they've got to find a way to both manage interest rates and raise interest rates higher while also trying to reevaluate in real time the impact of the Ukraine war on the U.S. economy.
And so with that, because as you noted, right, consumers are feeling the pinch at the store, at the pump. And so I guess you're expecting one rate hike next week, right? The 25 basis points seems to be the most common bet at that point, and then we'll have to see. Tell me a little bit about stagflation, because you say there's stagflation risk. Explain that to folks.
Yeah, so if I think about, what is stagflation? Stagflation is this combination of a stagnating economic environment, stagnating economic growth, paired with inflation. Typically, when you see inflation, you see that in a world of rising growth, of rising consumer spending, and it's usually a sign that things are going well, that there's some acceleration going on in the economy. Where we are right now is we're seeing inflation being driven not really from the demand side any longer, but it's increasingly on the supply front. So that's both the oil and natural gas issues, it's the wheat and food shortages, and then it's also these global supply chain disruptions. And so right now, the rising prices that we're seeing are not necessarily a result of growing demand, but more of these supply constraints. And that signals to me that we're likely moving more into a world of slower economic growth paired with rising inflation, and that's the stagflation environment that I think economists have been so scared of. Some people early on labeled, the period last year as one of stagflation, but we actually had really high growth during that period of time, and so this is a new environment. We're entering a new phase of the post-pandemic or post-pandemic onset economy.
So it's interesting because, the supply, while, we've had these supply chain issues and disruptions and such, you can go and get gasoline, at least for that piece of the puzzle, but it's incredibly expensive. At some point, you just have people say, you know what, I'm not going to drive to the next state to go visit my friend because it's too expensive. And so the question is, when does demand wane? Only because inflation is just too ridiculously high.
And again, I think that's right. And I think there are two things. One is going to be, you're going to see people pull back slightly on some of their use of gas. The surveys that we run showed that 50% of consumers in January indicated they try to drive less due to the elevated prices that they felt at the pump. But, for a lot of people, they're not able to really cut down on their travel. They needed to go to work. They needed to visit with family members. And so you're likely to see those price pressures manifest themselves in other areas of consumer spending habits, in particular, thinking about, high-end luxury goods and consumers gradually substituting in lower cost goods for those higher-end discretionary purchases.
Yeah. I'm supposed to wrap it up just quickly. When are things going to feel better? How soon?
Great question. I think right now we're actually headed for a period where things are going to feel worse before they feel better. So you're going to start to see the Fed tightening, and you're going to see that ripple effect play out. I think you're going to see growth come down slowly but surely. And it probably won't be until 6 months from now when we'll start seeing inflation come down, and hopefully by that point the jobs growth will continue to fuel the economy.
Yeah. Good to see you, John. Thank you so much. John Lear, it's great to chat with you all about the economy here today. Appreciate it. Morning Consult. Thank you, John Lear. Plenty more to come right here on Trading 360. Meridian Link is in the 360 spotlight after the financial software firm reported its earnings. The company's CEO is ready to join us and go through that report. Keysight Technologies is today's disruptor following its upgrade by Deutsche Bank. George Sillis will have the details and a way to trade it. And we will take a deep dive into those airlines in the 360 round. But up next, it's the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein goes through the technicals. Lucas Downey from Map Signals takes us through the trades for Archer Daniels Midland, Huntsman, and Matador coming up.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I'm gonna take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position?
You two are all set.
Choose the app that fits your investing style.
Welcome back to Trading 360. I'm Nicole Petalides. Happy Friday to you. Thanks for being with us. It's time for the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein will take us through the charts. Here to take us through the trades, Lucas Downey, co-founder of Map Signals, taking us first through Archer Daniels Midland. That's the first one of our big 3 today. Why did this one jump out at you?
Hey, Nicole. Just looking at the data on Monday, we actually saw the most stock selling since the pandemic lows. So clearly everything has been for sale, but there are a few areas of strength, right? Especially in the agricultural space, energy space, commodity space. Archer Daniel is one of those names that have been exhibiting relative strength. And whenever you look under the hood and you can look at some of their earnings, they continue to beat estimates. Last time that they reported, they also are talking about very strong guidance, and they just increased their dividend. You've got a world where commodity prices are through the roof, and you've got this conflict going on, Russia, Ukraine. It's really putting this big ballast, upward momentum on all of these prices. And I think Archer Daniels stands to benefit in this type of macro environment. So it's also got a PE that's just below 60. Yep.
Yeah, and we want to get to your trade. Let's let Ben take a look at the charts. I don't want to interrupt you. I want you to hold your thought because we're going to get back to you more on the trade and the charts. But first, let's let Ben lead the groundwork, too, on the charts on Archer Daniels Midland.
Thanks, Nicole. Hey, Lucas. And Nicole, good to be with you guys today. I agree with what Lucas has to say in terms of some of the fundamentals, and commodity prices are really attracting some attention. The one thing that concerns me, Lucas, is I keep hearing about Russia and the impact that they could have in terms of fertilizers for us here in the U.S. if things get worse. They're a big producer, apparently, and that was a factor that I hadn't really considered prior to listening to a story about it this morning. But take a look at this trend environment to the upside. You can see from 61.80 to begin the month of December, all the way up to 88 this March. Well, just shy of. But I also wanted to point out that dip, if you remember back in January, I think it was the 24th, we traded down to 66 on earnings. That turned out to be a great buying opportunity for investors, again, on the way up to this 88 high that we just mentioned. Now, I wanted to just take a step back from this intraday look. And let's pull up a quick look at the daily time frame in ADM. You can see they're holding above the 50-day moving average, holding well above the 200-day moving average. They haven't been below that basically since June of 2020. Now, I always talk about these 2 phases of development, and this is where I want to get into also I wanted to point out RSI a little bit overextended at these levels. So again, it's in overbought territory, but you can see how it's held overbought for a long period of time, basically since the middle of January. But let's take a step back, look at the weekly. And speaking of this kind of area of consolidation that we look for, this area of value where we just sort of see rotational, sideways, horizontal trade, it's limited in terms of directional conviction, but when you break out, and in this case we did the upper extreme, you get into a vertical type phase here where you see higher highs and higher lows, and that seems to be what we're in right now. I think the bulls are going to be looking for some sort of an area of consolidation to form here at this upper level. That's acceptance of these new highs, but yeah, a lot of fuel to the fire in this one in terms of some of the momentum to the upside as far as commodities, and again, it'll be key to watch this over the coming weeks and months as this all plays out.
Yeah, it's really seen obviously some nice moves here, right? When we've seen so many stocks breaking down of late, this is such a different picture, Lucas. So tell us more about your trade here when we think about this commodity producer.
Yeah, so I mean, what we do at Map Signals is we look at where the big money is going, and we also are ranking each of the stocks based on technicals and fundamental quality. So ADM is one of the strongest stocks that we have in the universe, and we're looking at like 15, U.S. traded stocks. So this stock really came on our radar right about the mid 70, 75 area. So I think this is probably a good play in this macro environment, low 80s types of environment. That'd be the price I'd be looking at for this stock.
Yeah. And, it's interesting, it comes on the radar, particularly everything that's going on with Ukraine. Final thought here, Ben, before we get to the next one.
Well, I'm glad you asked because, we were just looking at the weekly time frame and this vertical move out of balance that we're seeing right now. And I was pointing out the two phases of development. But I also want to point out how when you see trend to the upside, you actually see those areas of development, those horizontal areas start to develop at higher and higher levels again. So you have value moving higher. And again, that's how you see trend environment to the upside. But there's also something that's significant. So here I bracketed one of these areas, a key horizontal area development that went on for years. We're talking almost 20 years, roughly around the $15 to $20 level. But also take note, it's also important the middle of the range. And you can see how after breaking up above that 20-25 level, we actually pulled right back and tested the middle of that range and held. So again, now we're kind of looking more at this area balance, 55 to 25. Should we get an area of consolidation above that upper level, as I mentioned, that would be acceptance. But we don't really want to see price dip back down below 40 at this point. That would be a bit of a concern for that longer term weekly trend that we're looking at here to the upside.
Yeah, it's always good to watch those downsides and what could happen. You don't want to see that and how you maybe change your move. Lucas, that being said, let's move on to Huntsman when we think about chemical products and came out with some good numbers. Tell us a little bit about the company, what you're watching with the stock for Huntsman.
Yeah, so one of the other areas that has been showing relative strength are some of the materials areas. And Huntsman has been another name, just like Archer Daniels, where it is a top ranked stock and it's got a very strong technical score and fundamental score. So not only did they just report some really strong numbers last quarter, they just beat estimates across the board. They raised their dividends. I mean, these are the things that, in a really tough market like it is now, you want to be making sure that the fundamental backdrop makes sense for this type of company. And they are expecting to grow in the year ahead. So, with a forward PE that's right around 9, I think it's relatively cheap in this environment. But more importantly, the big money has just been rushing into the stock. And I think you want to be, betting on winners in this tape.
And sort of similar but different in what it is when we talk about materials and things that are being used here. Ben?
Very similar price activity you'd expect to see, and we are a bit of a bid coming into play, the 60-minute time frame. And join me as we look at the run-up from 31, so up to 42. Not as extreme in terms of what we saw as far as ADM, and here is a good look at the 90-minute time frame and the run-up. As mentioned, the bid environment, a bit of a pullback. Now, let's do this. Let's just take a look here at a couple of these areas of consolidation that have been forming on this chart, the 60-minute time frame. And to do that, well, let's bring in this drawing set. So here you can see a very similar pattern in terms of what we just talked about with ADM. You have horizontal consolidation. I've outlined the middle of that area. You get a vertical move out of balance, and then you start to consolidate, in this instance, around 36. Look at this big pullback we saw. Again, so we have number 1, number 2 is moving higher, number 3, an area of consolidation which moves higher, but we actually, in this instance, did pull back and just briefly below the middle of that range. So I want to stress here, when you get these tests right around the middle of the range, again, as long as we hold, that's key, but you also want to look at if we do get below it, it's not as significant as it may seem just to trade below it. You want to see a little bit of time spent below it, and in this instance, we didn't. Look, the V bottom right back up to this 38 level, so the bulls want to see it regain composure back up to the 42 level, taking a step back from that intraday look. The trend environment looks pretty well defined here to the upside. It's holding above the 200, holding above the 50, and remember we were talking ADM, how it has been overextended in terms of RSI. This looks like it has potentially a little bit room to run in terms of Huntsman. We've seen seen pretty good volume participation on this move up, but notice how it's actually started to come off a little bit as we came down. So again, I just want to real quick point out in terms of Huntley on the weekly time frame, you can see those two are different areas of consolidation that have formed to the upside, but yeah, not much to note of here on the weekly, just a well-defined trend higher. And again, like I said, the bulls really want to see this one work its way back up to 41.42, and then not only again break out above 42, but get that area of consolidation at a higher level, form value at that higher level, accept the new upper level, and ultimately that would be in continuation of the trend we've seen. We always say continuation more likely than change. So another way of saying the trend's your friend.
Yeah, the trend is your friend. And as you said, the continuation of what we've been seeing in the company on that earnings report, to your point, Lucas, you had that in the notes about how they've guided with some good news as well. I mean, when you're looking at charts, I'm sure you looked at a few today that you said, oh, no way, right? And you look at the trend of something like Huntsman or Archer Daniels and say, so much better because. Is there sort of a red flag to you when you look at the ones that you stay away from, Lucas?
Well, I mean, listen, I'm very pointed at the type of stocks that I wanted to bet long in this environment. I mean, Ben had mentioned fertilizer stocks, which we've been all over that, but they might be a little bit extended right here. I mean, they have just been going parabolic. So just trying to look, at what is getting bought, and it's very few, stocks out there. I mean, it's kind of like 10-to-1 sells to what's getting bought. So Huntsman is one of those very few names. The trend is your friend. And, as long as it continues to show outperformance, I think it probably is heading higher.
Right. Okay. Matador Resources. Now we move to the world of oil and gas, which obviously has been jumping, pulled back a little bit now, but tell me a little bit about that one.
Yeah, so I mean, obviously that is where the bull market is. It is in energy, and it's hard to find an energy stock that is not up a lot. I know Matador, looked at it in our data for years, whenever oil is doing really well, this one tends to score very, very well. And if we look at, their reported Q4 revs came in at 299 million. This is way above consensus. Their EPS came in well above consensus. They had a record year last year, talking about how well things were doing back then. And this was reported a while back. We know that energy prices have also just been increasing. And I think that they're going to be doing a lot. They're just going to be doing really well. You look at their score, they've got a very high technical, very high fundamental score. When we look at all the energy companies that we look at in our data, Matador is one of these top 20 type names. Those are the ones that have the strong fundamentals. They have the strong earnings growth. I think that this is one of those plays where you're betting on strength in this type of environment.
Yeah, your thoughts here as you take a look, Ben, at Matador Resources, MTDR.
Well, I think there was some interesting price activity this week in MTDR versus what we saw in terms of crude oil, because the energy products have pulled back significantly off the highs that we saw. For example, the WTI up to 130 this week, back down to near 100 for the most part this morning at one point. But relative to the broader oil and energy market in general, MTDR is still hanging in there pretty well. Now, I didn't draw the lines on this chart specifically because I wanted your viewers to just kind of be able to sort of identify it. I think if you're looking at price activity, there's just one thing that you should try and identify first and foremost, these areas of consolidation. So in this instance, your eyes should be drawn to the upper extreme around 48, the lower extreme around 34, 33, I should say. But you should also notice the vertical move out of balance. As we broke up above 50, we rallied all the way up to 57.50. That's the stopping price, where again, you've just gone a little bit too far, too fast. Lucas mentioned in terms of some of the fertilizers, a little bit overbought, overextended. But look what's happened. No real V-top, no rejection of that upper level. That would come in the form of trade back into the balance. Instead, what's happening on the 60-minute time frame, and don't get me wrong, this is the intermediate, more granular relative to some of the other time frames we'll look at, but you can see the consolidation forming, again, a form of acceptance of these new upper levels around 53. So here you can see the trend environment to the upside. We've been well-defined above the 200 for a while now, basically going all the way back to the fall of 2020. It's been kind of teetering around the 50, but it's a nice move up here in terms of what we're seeing. But hey, talk about, hold on one sec, because I've got the weekly time frame here I wanted to show you. Talk about, again, a big move to the upside. You can see, again, potential a little bit overextended, but here's my point. Notice, again, it seems like crude, the energy products have pulled back a little bit more than MTDR has, but this will be something to watch here in terms of the geopolitical tensions, everything that's playing out right now, whether you're talking energies, commodities, or all, it seems to be intertwined and ties back to those inflation fears that investors are feeling, but managing to shrug them off and focus on the positive here and some of the good times to come for some of these names relative to some of the headwinds that the broader market's experiencing.
And Lucas, you know, I think it's also interesting because you mentioned PE a couple of times today, and I'm so glad we're able to have this chat, all three of us, but you mentioned the PE on Matador, and, you know, at 7.5, what a big difference to so many other trades that we take a look at, right? Tell me a little bit about PE, what you are always looking for in relation to that.
Well, certainly whenever, you're looking at what's actually working in this tape, and we've gone over certain sectors, but also, there's just this value tilt that has been outperforming, over the near term. And, people are reaching out. They want to know, how do you play energy? It's on investors' minds. So we're just going in, looking at everything through the lens of data. Matador is just one of these names that just continues to show up. Big money is going into the stock. And the PE looks relatively reasonable. Obviously, it's probably a little bit extended here, but people are looking for ways to play this energy move. And Matador is one of these names that just continues to show relative strength. It scores really well, and the fundamentals look to back it up.
Yeah. All right. And Ben, you have final thought.
Final thought, remember I said relative to the crude chart, MTDR is doing really well. Let's take a look at that side-by-side comparison. Here again, just getting back into the weekly time frame, the run-up we saw off the lows from 111 all the way up to 57.50. And as we bring crude into the picture, you're going to see while MTDR is still holding upper levels, look at the pullback crude is seen off the 130 handle. So again, a pretty good look at what's playing out here as far as MTDR and CL.
All right. Thank you both. Ben Lichtenstein, thanks for adding that extra thought there. And Lucas Downey, always great to see you for the big three of Map Signals. Thank you. A great big three today. We appreciate it. Coming up next, we're ready for our Spotlight Meridian Link. After the financial software company reported its earnings yesterday, and the CEO is standing by ready to join us to discuss that report and provide an outlook for the company. Much more here on Trading 360.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then watchlist. When the default list appears, select the name box, then create watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watch list, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Trading 360. I'm Nicole Penelides, live in New York City. Only the Dow with the green arrow today, right now up 158 points, up 0.5%, 33,337. The S&P has turned into the red. It's been going back and forth over the unchanged line, 42.55. The Nasdaq down 111 at 13,478, and the Russell 2000's down 10 at 2001. The major averages are all lower for the week, with the exception of the Russell, that actually is squeezing out a gain. It's time now to spotlight Meridian Link. It's our pleasure to bring in the CEO. Nicholas Vlok is with us to talk all about the company's latest numbers in the world of financial services and loans. Tell us a little bit about the quarter.
Good morning, Nicole, and thank you for having us. We're very pleased with our Q4 and also our first year being a public company. Quarter, we were up 19% in revenue. Business performed really well from an EBITDA standpoint. The company is outperforming our peers and very profitable, coming in at just shy of 40% EBITDA margins. But more importantly, it was our biggest quarter and a record quarter from a booking standpoint in the business, and also signing new clients. So we feel we have vindicated ourselves as a newly minted public company in our first year, and truly looking forward to our 2022 and beyond time frame.
Right. So with that, when we talk about the loans and the demand that you've been seeing, I mean, it's everything from credit cards and mortgages and personal loans, and you really have the gamut. When I was going through the company and what it is that you do, tell us where you're seeing the most demand, what you're hoping for when it comes to growth in the next 12 to 18 months.
Very early on in the pandemic, we've realized that we have to focus on multiple growth levers in the business. And 20 and 21 was kind of a culmination of that. In our business, even with some of the headwinds around supply chain constraints on auto and silicon chips and even new home building materials, we've continued to look at ways to optimize and help our clients exceed and do better than typical non-Meridian clients in originating loans. And we've seen our client base outperform the market, given our offering, the platform, and the support we provide to them. I would say there's not a single loan channel that really stands out as superior or worse than the other. It feels like there's a bit of a compression that we're dealing with because of supply chain. Once the shackles come off, kind of hopefully 22, 23 in supply chain, I feel we're going to see a correction in that and come through. But our growth has come from multiple areas. It's better cross-sell, upsell. It's really focused on driving new client logo wins and accelerating go lives. We're sitting on a great backlog that we've created in 21 carrying into 22. And we feel confident in enabling and lighting up those clients on our platform is going to continue to help us perform and outperform the market. And that's really what's helping Meridian Link. The loan channels that you're referring, credit card and auto and HELOCs, my view is it's currently still facing headwinds. And in time or over time, that should start subsiding. But your guess is as good as mine. Will it be 22? Will it be 23? I think there's a fair bit of uncertainty in the world we live in today with the conflict in the Ukraine. Taking front and center.
Right. And so in the world of digital lending, I guess you have to wait, like everybody else, pertaining to some more clarity on what is to come. In the meantime, I mean, you're still doing all the loans and seeing loan growth, right, in mortgages and everything. Tell me about the partnerships, because I do see a few partnerships that have been occurring with the company. Why are these important? Are you looking for more?
Great question. So Meridian Link is a platform, and we live in the consumer lending ecosystem. We have, over the last decade or so, created a partner marketplace, which we've emphasized over the last 2 years as a real strategic revenue stream for us. And we've today got about 600 partners that integrate into our platform, that participate in enabling lending to be more efficient, faster, smarter decisioning, analytics, and more automated. So from a partnership perspective, the company would love to expand that. it's also creating a strong defensible moat for us against competitors who's much more point solutions with either an account opening solution or a specific loan channel solution. Integrating partners and data providers into our platform is one of the things Meridian Link does really well and differentiates us. So partnerships, we believe, is one of the key levers for growth in the years to come, and we have a very strong partner model and welcome partners to be part of the ecosystem of Meridian Link.
And so with that being said now, and you know, we still talk about digital lending, cloud-based. So, you know, this is still evolving, right? You really got pushed, especially during the pandemic. You probably were in the right place at the right time with that going forward. In the meantime, you have a rising rate environment, most likely, right? And at least today we see it moving higher for yields. Tell me a little bit about some of the conversations that you have, and some conversations that may be tougher than others if you have a rate that continues to rise higher.
Another great question here. So let's just define where Meridian Link plays. We play in the 100 million to about 10 billion of assets under management space, which is the mid-market financial institutions, credit unions, community banks, regional banks, and then also credit reporting agencies. Our offering enables these mid-market folks to punch well above their weight and compete with a platform against larger financial institutions. By having said that, 2/3 or more of our clients are depository-taking institutions. And while mortgage will come under pressure with the rising interest rates, mortgage is kind of a mid-20% contributor to our revenue. The rest are other loan channels. And our customers, especially the depository-taking institutions, are benefiting from interest rates more normalizing. It creates a bigger spread for them where they can run their business. So I believe over time, a rising interest rate will be a tailwind for Meridian Link, given our depository-taking client base out there. I'm also of the belief it needs to be done responsibly and kind of feed into the market over time. But most of our clients will be the benefactor of a rising interest rate given their business model as a depository-taking institution.
Good to see you, Nicholas. Thank you so much. A great conversation. Congratulations on the quarter. Always wonderful to have you back on the show. Thank you. Nicholas Block of Meridian Link. Thank you. Coming up, we're going to be talking about the disruptors. George Tillis is standing by. In fact, this next name got a buy rating over at Deutsche Bank. He's taking a look at Keysight Technologies. And George will have all the details and an example trade for you.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
Welcome back to Trading 360. It's time for the Disruptors. George Silas is here with us. He's talking all about Keysight Technologies. The ticker is Keys, and we did see Deutsche Bank with a buy rating today. Tell us a little bit about this one, George, as you're taking a look at Keysight.
Yeah, I mean, in the technology space, Nicole, there are some upgrades going on despite some of the market downdraft we've seen since November. But Deutsche Bank did upgrade Keysight. They've got a buy rating with a $176 price target. Effectively, it's an interesting company with a few competitors. They actually are in testing and measurement. They actually specialize in semiconductor spaces that include 5G, automotive, industrials, and manufacturing markets. Everything has to do with 5G and the supply chain constraints. Electric motor vehicles, if you will, but also conventional automobiles, which use a lot of technology right now. This is a company that provides the analytics, software, and systems testing tools that help effectively businesses and manufacturers reduce the time to market, but also improve quality control, as well as enhance efficiencies when it comes down to manufacturing productivity. So it is a company that's not immune to the market, Nicole. It's been down significantly in the past 3 months or so, but overall in the last year, it's actually trending higher of about 8.5%. And I think it's an interesting company because it really encompasses so many different industry groups that utilize its testing software services. If you look at semiconductors, electric vehicles, all autonomous driving, any automobile now that has so much technology in it, despite if it's conventional gasoline or electric vehicles. But also, if you think about 5G, that's another secular trend that utilizes Keysight's technologies to test 5G equipment, which we know is still being deployed as of late.
And so when you look at that and you think about some of the competitors and the example trade that you have set up for us, tell me a little bit about that, because there is some optimism now surrounding this name.
Yeah, there is. I mean, there's a couple $1 billion in cash on the balance sheet, so it seems to have some cash funding, if you will, when it comes to, of course, deploying capital expenditures for the next cyclical maybe recovery we'll see in technology, which again, Nicole, we have to keep in mind the market is still relatively weak. The bears are still in control, but eventually we'll get a tradable bottom maybe in Q2 or Q3 later in this year. But it is certainly a name that's attracts some attention from analysts, and I think a lot of these names have been quite aggressively oversold just because they're partaking with the rest of the market, which is in a sell-off. But overall, if you look at some of the opportunities in it, one could certainly buy the stock if you are bullish on the stock, but also you could consider a stock replacement strategy by selling cash secured puts, and effectively going out to April, one could sell the April 140 put options for about $3.25 a share, or $325 a contract. So this effectively is a strategy under the assumption that a trader is willing and able to take ownership if the stock does trade below 140 between now and expiration. Break even is around 136.75. So if you're assigning the shares at 140, break even is about 6% lower than the current price, or about $9 below. So it gives us some cushion just in case we see a continuation of a sell-off in the market. But it also is a strategy if you wish to take ownership of the shares at a lower price. This is what you can do.
All right. Good luck there at Keysight Technologies. Keys with George Silas today, our disruptors. Appreciate it, George. Thank you. Have a nice weekend. George Silas there.
You too. Thanks.
Coming up next, we're ready to talk all about the airlines in our 360 round. How will rising fuel costs impact the major carriers? Why should investors be considering some of these names, or which ones should they avoid? Coming up.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting drawings, drawing tools, and then type of drawing. For symbol comparisons, select studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes
Oh,
away.
wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Ben Lichtenstein here with your TD Ameritrade Network futures market update. Stocks and stock index futures products are selling off. The overnight highs we saw ahead of the cash open as investors weigh the impact of geopolitical tensions and inflation on economic conditions ahead of the Fed meeting next week. The ES is hanging out right around 42.40, fractionally lower. The data this morning from the University of Michigan didn't help the bulls out any. Consumer sentiment, the lowest since late 2011 at 59.7. It dropped 3.1 points and missed expectations, while the 12-month inflation gauge popped to 5.4% from 4.9, and it's the highest since November of 1981. The Nasdaq's down around 1%, hanging out in the middle of that 13,000 handle, right around 13,500. I guess what you'd expect to see with rates on the rise again today. For the first time, we've got futures here now lower again, with the on-the-move lower, I should say, this week, with the ZT, the ZF, the 2 and the 5-year notes. They posted new lows for the year. That's got the FBX nearing the Feb highs, up around 2%. The TNX is just above 2%, and the longer-dated 30-year this week just got back above 2.4. Keep in mind the shorter end of the curve is more closely tied to the Fed. Their March two-day policy meeting begins Tuesday. Expectations are Wednesday. They'll raise by 25 basis points, the first of possibly 4 or more this year. This has been your TD Ameritrade Network Futures Market Update. Now back to Trading 360 with Nicole Pedalides.
Ben Lichtenstein, thank you for that report. It's time for our 360 round. We'd like to focus on the airlines. They've sold off recently as oil has been spiking. Despite that, one of our guests here says to avoid panic selling in this group. Colin Scarollo is with us, equity analyst at CFRA Research. In fact, he has some buy ratings he'll tell us about. And Kevin Green, senior derivatives manager at Charles Schwab. Thank you both for being with us. I was looking at that long chart, the airlines versus the S&P in your note today, Colin, and it shows like sometimes airlines can be such a great investment, but it's not for the faint of heart. You still have some buy ratings, though. Tell me, is now the time to get in there and why?
Thanks for having me, Nicole. Yeah, we actually upgraded. We had 3 5-star strong buy rated airlines before the Ukraine invasion. We actually we added another one, United Airlines, to that list just this week, because we think history tells us that when oil prices have spiked up, there is some impact to airlines, but it's usually not nearly as bad as the market expects during that initial spike in oil. So, for example, you had airlines drop around 30% during 2011, the last time we saw oil spike like this. But that was actually an excellent time to be buying airlines, because you had a good demand recovery coming out of that 2009 recession, and that actually overcame the oil cost increase. And you still had pretty nice earnings growth out of airlines. We think we'll see the same thing over the next 2 years. So we're recommending to keep buying airlines as they've gotten cheaper through this sort of overreaction to the oil price spike.
I see. And you're still expecting demand and the reopening and all that. That being said, Kevin, I know you're looking at some of the basics that these companies are truly facing, including inflation, labor force, which has seen a lot of churn, higher wages, things like that. Tell me a little bit about your perspective here, Kevin.
Hey, Nicole. Yeah, the airliners, although they have sold off and they might look like a value, I think you're going to see a lot of headwinds because of the inflation fears that we are having in this marketplace. And the inflation that we are seeing is coming because of staple goods, coming from food and energy. And that's really not a good setup when it comes to the consumer demand, if you will. And then also we have the geopolitical tensions that are out there. The rising oil prices themselves will have an impact on some of these airliners. And unfortunately, I think if we see the consumer slowing down some of the consumer discretionary spending, which includes travel, we could also see a little bit of a slowdown in demand for airlines in general. So it's really hard to really navigate what crude oil prices are going to do, and then also what the consumer is going to do. But Nicole, last thing I'm going to call out is EU. If the EU goes into a pretty significant recession, as you're already seeing some pretty staggering inflation numbers coming out of Italy, that could also slow down tourism, as domestic citizens, U.S. citizens may not want to go to a country that has expensive goods, if you will, because it's just going to cost them a lot more. And I think you're going to probably see the U.S. consumer, if you will, probably focus more on domestic travel for the near term, at least for the next 6 months, in my opinion.
Yeah, I mean, there's certainly a lot of uncertainty on certain parts of this. Colin, tell me a little bit about the buy ratings that you do have. Maybe you like some. I see 4 strong buys, and also love here for Boeing. I paused because love was your Southwest airline call too. No pun intended there. But you do have 4 actual airlines plus Boeing as things to get into. Can you tell us where you might have the most conviction?
Yeah, so I think one of the things to keep in mind is we've been seeing real wages, wage growth minus inflation. It's actually been in negative territory for the last 6 months or so with how high inflation's been. But we've still been seeing pretty nice recovery in air travel demand. And just in the past month, volume through TSA checkpoints is up about 30% month over month. Ticket prices are up 15%. And I think that's a reflection of, regardless of these headwinds on the consumer, there's just so much pent up demand out there to get back to traveling again. I really think that's the case both for families, households, as well as businesses. So we're going to see that sort of trumping any pressure from inflation, we think, on the demand side. And then in terms of Boeing, we actually upgraded a lot of stocks during this recent sell-off in the aviation space. We went to strong buy on Airbus. We also went to strong buy on AerCap, the largest aircraft leasing company. And we just think there are headwinds. We certainly acknowledge that, and a lot of risks. But we think this sell-off has just gotten way ahead of what the actual fundamental impact to earnings is going to be. And I'll give you one example on United Airlines. If they just get back to, call it, half of the earnings per share they were generating before the pandemic. So think about that, 50% less net income. They'd be around $6 per share. And we think that a valuation on that new normal would still generate huge upside from where we currently are. So we think the sell-off's just been extremely short-term focused. And as we get out, second half of this year, we've already seen oil come down drastically in the last week. But we think by the end of this year, the impact that we're going to actually see on demand and costs is going to be way less than this hyper fear environment is expecting right now. And that's where a lot of the upside in these stocks will come from, in our opinion.
Right. So certainly feeling like the group is overdone to the downside. Kevin, I know you had American Airlines on your mind as you were talking about international versus domestic. What are your thoughts here on American, or just the big play on the reopening?
Yeah, Nicole, like I said earlier, it's a little bit difficult right now to see exactly where these airliners are going to be able to see a little bit of a move to the upside, because it is also a very low margin business, if you will. And with the rising costs in oil, it's going to impact them. If we're looking at this particular chart for American Airlines, you can see a downtrend from the July highs that we saw last year. And we're actually in the territory of the COVID lows, around the COVID lows. And so that trend is showing a downtrend as of right now, but there is a little bit of a support area at the $14 level, which is where it's pretty much trading at right now. If you see a little bit of a consolidation, that might be a bullish indication of a potential move to the upside. And if you're kind of looking at a resistance level at this point in time, near term is looking at like $18, around the $18, $18.50 range is going to be a resistance. So right now the chart's still showing bearishness. If you can see some consolidation, it might provide a little bit more of an optimistic view on the stock.
Yeah, overall, right, understood. So Colin, final thoughts here as you see the demand continuing to grow. The pandemic is, you know, at least abating, right? I won't say it's over, but it's no longer the fears that we had prior. I don't know if you expand it out to other things that we should look at as well in the big picture of the market, but certainly airlines are good to go, huh?
Well, yeah, I don't want to pretend that there's not a lot of challenges still ahead. You know, we're still down about 15% in terms of passenger volume in the U.S. versus March of 2019. So there's still a lot of recovery ahead that they have to get through. But I think it's going to naturally progress in that direction, in an upward direction. You think about right now, we're still something like 50% down in terms of international travel. And I don't think there's any inherent reason for that other than the sort of onerous restrictions the government still has on international travel. I don't think there's been any fundamental change in how people want to go overseas for vacation or for business. So that's going to be a big leg of the recovery during the rest of this year, we think.
All right. Thank you both very much. Colin Scarola of CFRA and Kevin Green of Charles Schwab. Thank you both very much. Great conversation on those airlines. Thank you. Can't wait to get on some. That's going to do it for us here on Trading 360. I'm Nicole Petalides. I will see you at 2 p.m. Eastern Time for the watch list. But keep it right here. Fast Market.
Let's walk through how to analyze a company's financials on thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave them thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. thinkorswim by TD Ameritrade.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade network.
afternoon, traders, and welcome to Fast Market. I'm Tom White, and we have a great show lineup for you today, including discussions and example trades in mega cap tech names Tesla and Netflix, along with sentiment data on Airbnb out of Likefolio. But now, 2.5 hours into the trading day, stocks are lower as tech shares erased an early advance as investors assessed the impact of the war in Ukraine on the outlook for economic growth and inflation. Risk sentiment got a pre-market boost after Russian President Putin said certain positive shifts have occurred in the talks between the Kremlin and Ukraine. But stocks gave up those gains as traders assessed the comments and consumer sentiment data that came in at 10-year lows. Now let's take a look at those major indices. S&P 500 off 0.3%. The Dow Jones Industrial Average, the only major index in positive territory, up 0.2%. NASDAQ slipping into the red 1%, down nearly 3% on the week, and the Russell 2000 down 0.75% to wrap up the week, volatile week to say the least. But to help us break down the market action, let's bring in my co-host Kevin Hinks, and also joining us today is the co-host of Next Gen Investing, Alex Coffey. Kevin, I'll go to you first. We talked about this earlier in the week, a consumer sentiment data point, and I said 60 might be breached here. We got it. We haven't seen these levels since September of 2011. So the outlook's not good according to the consumer.
Well, how could it be, right? Based on everything going on in the world and basically a look at consumer sentiment on 600 households. Here's what consumer sentiment does, Tom. It measures financial conditions and attitudes about the economy. Well, how could they be? Based on the last couple of weeks, how could they be good? Tom, if you put up a 1-minute chart of the E-mini future, overnight to now, you know what that also was a chart of? Kevin's attitude today. Because I had a little spark of positive and it has gone straight down since then. I am not in the best mental state going into midday Friday, Tom. Ring the bell and get this week over with. But so if you put up a chart of the E-minis, that's also a chart of my attitude today, Tom.
Yeah, and you're rattled here, Kevin. Your staunch optimism is getting hit this week, and I don't blame you, because earlier in the week I was getting really nervous about what was going on. You hear these headline risks, not only geopolitically, but then starting to use natural resources as a weapon, right? Moving forward, that's danger for not only the U.S. economy but for the global economy. So there's reason to be, not optimistic at this point, because we just don't have a timeline on the conflict. But Alex, let's bring you in here. We're looking at volatility today. I know that was on your mind, and I'm surprised that the VIX actually isn't positive going into the weekend.
Yeah, well, first off, I want to comment on Kevin's, forever optimistic personality, maybe showing some signs of cracks. Maybe for investors at home, that's a sign of capitulation here in the future. So that could actually be a good indication. If we're cracking even the ever optimist Kevin Hinks. But one of the things that I've been watching all week, Tom and Kevin, has been volatility, because while the market itself has been choppy, to say the least, we haven't really gone anywhere. But we've had some scary times. Of course, we've had feats and starts of optimism, big up moves that in many ways didn't hold entirely. But all the while, volatility quietly hasn't really gone higher. Obviously, it's at historically elevated levels, so we have to keep that in mind. But the same could be said from oil volatility as well. Earlier in the week, you had a day where the market was down and equity volatility was lower. You had a day where oil volatility was down, but oil was higher, which are counterintuitive to what you'd think in terms of the velocity of risk. For me, that was, there's never a perfect tell, guys, as you've known throughout your trading careers, but there's things that make you take a second look at things and question, what is this telling me? Obviously, we're focused on the whys often, but I always look at the what first. What is actually happening, and then we can try to figure out why after the fact. And so that was something that stuck out to me throughout this week. and it continues to be the trend, because as we head into the weekend, Kevin always talks about the last hour of trading. I think today is going to be a very important last hour of trading to get a concept of, what kind of risk both professional traders are looking to take, and of course, your day-to-day swing and day traders too, as we go into the close, because as you guys have both probably noticed, there hasn't been a huge risk appetite, probably for good reason, going into these weekends, as we've seen sell-offs and spikes in VIX. They haven't been taking the weekend out of premium, we'll put it that way, in terms of options.
Yeah, and we see that on a consistent cycle, Alex, where the VIX will start to fade on Friday no matter what the market's doing, and then no matter what the market's doing on Monday, we see it pop back up a little bit. But going into a weekend here, Kev, we've seen this over the last couple of weeks, and honestly, since the start of the year, that we're starting to see fades in stock. People don't want to be long going over the weekend because we just don't know what's going to come out over the weekend. But if you look at that consumer sentiment data number, the points within there, you look at the headline number, it's a bad one, right? The current conditions number, it's a bad one, 13-year lows for that one. What stuck out to you in this report that basically explains the fact that there's uncertainty out there everywhere?
Listen, I think forward-looking numbers are important, right? Because when you think about consumer confidence, consumer sentiment that we got today, those numbers are what the overall world, and remember, this is 600 households, so it's a relatively modest sample size, but it's not insignificant. And they look at, this is basically their opinions on the economy going forward. And remember, this is University of Michigan, so it's every 2 weeks. Yeah. We get a mid-month, which is this one, and then we get the final at the end of the month. So 2 weeks is a pretty good snapshot. If you look back the last 2 weeks, that's about as long as this war in Ukraine has been going on. So how could this sentiment number possibly be a good number today, guys? So it's not really surprising that it missed expectations. It's not surprising to me that it was lower, but I think Alex touched on something here that our viewers can learn from, and that is there's information in trades. Every trade that you see made or you make yourself, there's information in that trade. When you see the VIX starting to peak out, right? The VIX up around 32, let's face it, it needs inertia to go higher or stay at that level. Crude oil, what it's doing, overall commodities, overall stocks, they're starting to take the big edges off this move, guys, in terms of where volatility was, where crude oil was. All the highs or the lows in terms of stocks are kind of in here. So now we're starting to work into a little bit of range. I think that's important. I think Alex identified something that's significant. Understand the information that you get from that, that watch list that you have up there. And when the market is down, but VIX isn't up, right? Things like that. There's a lot of information to be taken from that watch list that you have on your platform, guys.
Yeah, and I wanted to kind of take a look at the sectors here, Alex. And it's kind of a quandary for me because leading the way to the upside in the S&P 500 are financials, and we got yields down. And, even when yields were rising earlier this week, we had financials down. It's kind of flip-flopped. And then oil's up over 2%, and we got energy stocks that are leading to the downside in the S&P 500 sector watch list. So what's your take on this? Because it doesn't seem like it's making sense right now.
I think that if you think in terms of day-to-day, minute-to-minute, hour-to-hour, you're going to find that these correlations aren't perfect. But what's the general trend been as of late? Financials have been lower. Maybe on a short-term basis, they could be considered oversold. At the same time, we've seen the bond market move sharply lower over the last few sessions, over the last week, which has put a bit into yield. So I'm looking at more general directions as opposed to day-to-day, hour-to-hour, minute-to-minute. And the same could be said for the energy companies. They've had a meteoric rise, as has the crude oil commodity, but it's pulled back a little bit. It's stabilized at historically elevated levels. And like everything, just like Kevin was kind of describing a situation where the air gets a little bit thin for volatility at a high level. Of course, volatility is perceived as a mean reverting asset, and we don't consider price to be that way. but everything can get overbought and oversold. And I think in both cases, you had a situation, Tom, where they got a little bit ahead of themselves. We've seen an over-rotation, and they're sort of normalizing. Doesn't mean that those trends, both lower for financials and higher for energy, have been damaged or aren't still intact, and that may not be the continued trend going forward. But it doesn't go straight one way continually forever.
Yeah, maybe a little bit of profit taking in some of those oil companies. And then we had the news out yesterday that Congress.
And Tom, it's important. If you look at the activity in the energy sector today and why they might be lower, 2 words, right? Windfall tax.
Yeah.
On the energy companies that they're mentioning, that was on the news this morning on the news programs, and I was listening to the presentation on how they were going to justify putting a windfall tax on the energy companies. Tom, I could feel my IQ going down just listening to the presentation on how horribly they were justifying. You know, if you want the U.S. companies to up their production, this is what you should do to them. Put a windfall tax on them. It's amazing to me how short-sighted we can be sometimes, Tom. But I think that's why the energy stocks are in the red today, Tom.
Hey, if I could real quick, Tom.
Yeah, go ahead.
0.9% lower is really negligible when you consider how far these stocks have come. We'll see what happens when it comes to, some of the political rhetoric and, of course, the decisions made from a windfall tax. But I'd also, note, too, that, the type of oil that comes out of Russia is not the same type of oil that we drill here in the U.S. So it can be a little bit, kind of, I guess, misjustified to say that it's just as easy as, drilling more oil here domestically to replace that. They're kind of different products and they're used for different things. And the infrastructure is different in terms of how to distill that oil. So it can certainly help, of course, if we bring more supply on potentially here domestically and with some of our other trading partners here nearby. But it's not entirely the same product. I think that's important to know.
Good point there on crude oil, and you expect it to continue to be volatile. We've had some big swings in there in the energy market, and talk about inflationary pressures. That's going to be one of them. If I see one more tweet of somebody taking a picture at a gas station with the total that they're paying for a tank of gas, my head's going to pop off, because I live in Chicago. I understand the pain there at the pump. But Kevin, one of the areas of the market that's kind of been, barometer for the overall fall in the market has been tech, and especially the cloud names. Now, when I look at this space, probably got ahead of itself into those all-time highs and a lot of those companies into October and November of last year. But at the same time, are these companies insulated from maybe geopolitical tensions, maybe consumer spending? This is based on companies spending and expanding analytics and data gathering and putting everything on the cloud, making business easier in that tech space. But the valuations were really high. We've seen most of these names pull back anywhere from 20 to 50% in the cloud space. CRM, Adobe, ServiceNow, Snowflake. Your take here on this sector? Yeah, well, I mean, the first thing that gets hit when interest rates rise are growth names, right? Yeah. All those growth projections have to come down, and there's, frankly, that sector that you were talking about, though steeped in high quality companies, and you can go through subjectively each one, they're all going to come down. You mentioned what the key was, Tom. It's higher interest rates and valuations, and those two have trouble, staying in the same, going in the same direction. So when interest rates were low, it was easy to justify the growth in these tech names. Now with interest rates going up, sitting up near 2%, and a Fed funds hike coming next week, it's not surprising that they took some percentages of valuation out. But now the question is, Tom, which one of these are getting really, truly, fundamentally inexpensive? And that's where the stock picking part comes in, because you said it. Some of the percentage that these stocks have sold off, it's eye-opening, even for someone who's seen a lot of this in his career. Some of these percentages are big, Tom. Yeah, and rising interest rate environment. Now, also, What about balance sheets of companies? Because a lot of these companies rely on CapEx spending from these companies, Alex, and that's a concern moving forward because one of the things I've kind of been hitting on this week on the show is the fact that earnings growth expectations have not really been cut across the board. They've come down a little bit, but they haven't been cut like the overall market has. So your take here on this particular sector, moving into the middle stages of 2022.
Well, let's kind of tie this to the entire macro picture and where we're headed, Tom, because you're talking about the earnings projections going forward. I think this is really, really important because we've had so much commentary and focus over the past few months on the inflation conversation because that was the primary kind of risk factor that everyone could see and everyone was hoping would turn the corner here in this first part of the year. Well, now with all the geopolitical stuff, Tom, it's a little bit more unclear whether or not we're actually going to round that final turn for the inflation anytime soon. And so I think things, and this ties into the consumer sentiment conversation as well, where now we have a Fed that is forced to take some sort of action. We've already seen them wind down their balance sheet purchases. We're anticipating with some certainty that there's going to be at least a 25 basis point raise next week, and that begins the liftoff in the raising cycle, Tom. Well, the next piece is, what does the economic picture look like? Because, a quarter ago, there was no talks of, coming recessions in sort of the consensus viewpoint. But now, you see consumer sentiment data. Of course, it tails off even further when you look at the expectations. And you talk about earnings projections going forward, not yet being trimmed to the same extent that we're seeing some of these expectations from the sentiment. At some point, this becomes self-fulfilling, Tom. And so, to me, the most important data points now on the horizon are going to be your forward-looking kind of survey-related data, things like PMIs and ISMs, and of course, individual company earnings reports. So I think it's extremely important, particularly within this cloud sector, that so much of their story is tied to growth. But this extends well beyond just these cloud companies, Tom. I think this matters for the entire market. I think that this is now the most important risk factor looking forward.
Yeah, definitely. That's. I think if you do any conference calls on the upcoming earnings season that kicks off in a few weeks, we're going to hear the word inflation used quite a bit. And then we had some of the economic data. The big point next week will be that FOMC meeting announcement on Wednesday, the expected 25 basis point hike. What will that do to this tech space that's already been hammered pretty significantly? But Kevin, one of the big names that's getting hammered today, mega cap tech name is Tesla, down near $800 a share. It was in positive territory earlier, like a lot of the tech names. Give me your take here, because Tesla's down over 30% from those all-time highs that we saw just about 5 months ago.
Well, I think Tesla is a very interesting company. They are clearly the leader in the EV space, right? Over 70% of market share. I see Fiat around 14.5, BMW around 7, Porsche around 5. Everyone else is lower than 5% or close to 0. They are clearly the leader, and that 72% is down from about 80%. So Elon Musk is, the leader in the EV market. Make no mistake about that. Now, there is competition coming in the rearview mirror, and there are supply chain headwinds for every single car company. But I think starting production in Berlin is important. Austin is very important as well. I think Berlin will solidify or calm down any risk about Europe and bringing cars to that area of the world. I think that's hugely important. I think Elon Musk continues to do good things, not only in Tesla, but in his other companies as well. I think you have to look at them all together. But Tesla has got a big lead in terms of EVs, and the momentum in the market is going towards EVs, not away from them. So this is a company, but every time we talk about Tesla and all the good things that we can say about Tesla, you also got to talk about valuation, right? The valuation is always the problem because they have such loyal, passionate fans of this name. It's always just, every time Tesla sells off, you're like, well, it's valuation coming down.
Right.
So you've got to be cognizant of that. But I say this a lot when we cover Tesla on this show. What does Elon Musk have in the pipeline for that company? That would always worry me if I was trading Tesla from the short side, because at any moment he can do something that can rip the top off this stock. Will he? I don't know. I have no idea, right? But you're always wondering what that incredible brain has going on inside it, guys.
What innovation's next for this company?
Yep.
And Alex, if you look at this, they're raising prices on some of their models. Demand is still there. Now, the geopolitical issues that we are having right now, and almost commoditizing a lot of the natural resources that nickel's used in every electric battery out there. So this might cause some consternation. Piper Sandler came out with a note earlier this week saying that, hey, Tesla could be used as a pawn if, there's more conflicts coming between major countries. Your take here on this, with the stock down this much, failed at its 50-day moving average. What's your take here when the market's telling you?
Well, Tom, I think you're talking Tesla, one of the most widely traded names, obviously a very popular name amongst retail traders, and for good reason. Few names had this type of performance at this size market cap over the past few years. Stock had just an incredible run. I mean, that chart says it all over the last 5 years, but really this has been over the last couple years, as you see, just a tremendous run higher. But of course, that comes with the volatility tax. The stock outperforms the market by a wide margin. In many cases, it's a high beta name. So on weak market days, oftentimes you'll see weak Tesla as well. And obviously has ties to the energy conversation, is ultimately an alternative down the line to gas-powered vehicles. This is electric-powered, so looking for that down the road. But Tom, when you're looking at trading a name like this, I think that these fundamental factors, these macro factors, play a bigger role the longer term your horizon becomes. So if I'm looking out the next couple months, yeah, clearly there's a lot of risk factors still on the table. But if I narrow that down just to next Friday, for example, yeah, those things still exist. But these type of headlines, these types of things, yeah, there's certainly possibilities for surprise, but it eliminates some of those long-term shifts in terms of keeping things narrow. But we still have the heightened volatility because it's always kind of out there. And so as long as we're trading this risk defined in either direction, that sort of ultimate surprise risk, we're protected from kind of the risk of ruin through risk definition, but we also can take advantage of that heightened volatility, keep the time frame short, so that in the event that nothing really changes really systemically, then maybe we can take advantage of that. And so what I was looking at, guys, as I sent over earlier, was looking at something in the unbalanced butterfly family, but keeping the units 1 by 2 by 1 and just selling a slightly wider put vertical. The reason I looked at this is you can name risk factors on both sides. You can find reasons, Kev, to make the stock go higher. And so I wanted to do this for a credit overall. But you could also find reasons why this sell-off continues lower. I centered this around 780. So I did the 785, 780, 775 for a little bit over $1.25 or so credit. And so, Kevin, that 780 mark corresponds to the low of this week. And so if we retested those lows and kind of hung out there, that's the best case scenario for this trade. But make no mistake, this is a neutral to bullish strategy with kind of a downside kicker if it sort of eased down towards our short strike.
Yeah, and right now, currently trading about $1.50 credit on that, Alex. That would, if you collected $1.50 credit, that's the most you can make above that 785 strike. So you're buying one of the 785s, selling 2 of the 780 puts, and then buying one of the 770 puts, collecting $1.50 credit. You've got $350 in risk at that, and that's below that 770 strike. But you mentioned the kicker, the apex of profitability at that short 780 strike, which you sold 2 contracts at. But because you're collecting that credit of $1.50, you've got no risk to the upside above that break even of 773.50. Kevin, your take on the unbalanced butterfly?
Alex Coffey has spent enough time with me to know that there are several different ways to unbalance a butterfly. You can do it in contracts like we've done many times on this show, or you can do it in terms of the strikes. And Alex has gotten to his credit via the $5 long vertical and the $10 short vertical. Another variation on a butterfly that makes this, by definition, unbalanced, right? And so on the upside, this trade gives you the opportunity to be profitable in either direction. Now, at some point, you have risk on the downside through the 780 strike and then lower than the 150 credit that you took in. So there's where your risk comes in. But Alex has, given himself that opportunity that if nothing happens, you collect a credit and you're profitable.
Right, and as I mentioned, if you collect a $1.50 credit, that break even is going to be $773.50. Wrap it up for us here, Alex, on the unbalanced butterfly in Tesla, where you're giving yourself a little bit of a cushion to the downside.
Yeah, obviously it's omnidirectional because we had the best case scenario move lower, but this is a strategy that is neutral bullish, as I emphasized. Best case scenario to eliminate stress for this one would be a move higher in Tesla. We keep our credit, we move on. Obviously, the break-even's quite a bit lower than where we're trading now. There are 4, contracts associated with this for every one time we do it, so it's a little bit more fee-intensive. So keep that in mind. And then also a shorter-term trade with the best case being with part of that trade being in the money. Just know that assignment and exercise risks increase the closer we get to expiration, and the more those strikes are in the money. Most traders who would put this style strategy on would look to close it prior to expiration, if at all possible.
All right, great rundown on that example trade there in Tesla, taking that neutral bullish stance. All right, that's going to do it for this segment, guys. That's Alex Coffey, the co-host of Next Gen Investing, joining us. But coming up after the break, Kevin and I will be joined by Megan Brantley from Likefolio for a discussion on sentiment data on Airbnb. Fast Market will be right back in about 2 minutes.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then watchlist. When the default list appears, select the name box, then create watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watchlist, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then add to watch list. From the Scan tab, right-click a security and then add to watch list. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
Welcome back to Fast Market on the TD Ameritrade Network. I'm Tom White, joined by my co-host Kevin Hinks. But let's bring in our next guest for our cash tag segment. That's going to be Megan Brantley, the Vice President of Research at Lightfolio. Megan, thanks for being here today.
Yeah, happy Friday, guys.
Oh, happy Friday is right. This has been the longest week of my life here as the market's gyrating around. But want to get into a discussion about Airbnb. It's kind of outperformed so far this year, but still at low levels and still off all-time highs. What kind of data are you seeing for Airbnb? Because I get it. It's a pandemic winter. People wanted to get away and they didn't want to go to hotels, or they couldn't go to hotels. A lot of them shut down. But now that things are opening up and it seems like hotel prices are skyrocketing because demand's there, what's that looking like for Airbnb as far as sentiment data goes?
Yeah, so this was a fun one that we wanted to bring to you guys because this is actually one of those instances of kind of divergence developing in our data where we see significant strength building in Airbnb. Whenever we look at consumer demand, so mentions of people who are talking about booking with an Airbnb on a 90-day moving average, those mentions are about 25% higher year over year. And a lot of that is driven by now consumers are starting to, go to hotels in urban areas, and they're even starting to travel internationally. But I think what's interesting is that, this shows you that 90-day moving average growth rate, which is a longer term lens. And then when we narrow in and when you look at how Airbnb is performing versus peers on, a shorter lens, a 30-day moving average, that growth rate is actually higher than 50% year over year. So this booking rate for Airbnb is accelerating, and it's not just accelerating, it's accelerating quicker versus peers. And so I think this was a case where, last fall, whenever we started to look at this, whenever travel really started to open back up, we saw a lot of comparative strength out of these traditional hotel names who had been, so weak previously because of the pandemic. And now we're starting to see kind of that pendulum swing more in Airbnb's favor. And, in general, all travel in our data, we see a lot of pent-up demand. We see a lot of people who are talking about getting out there and traveling. So all of these names that are listed are showing this year-over-year growth, but Airbnb seems to be excelling, and it seems to be accelerating even in this past month. So it was one that definitely caught our eye, and we wanted to bring to discussion to see what you guys think as well.
Megan, when I look at Airbnb, my first question is, who's their competition? On your purchase versus sentiment, you've got all hotels and then Airbnb, which if I'm getting compared to hotels and I'm Airbnb, I really like that comparison because I'm out there on my own. And what surprises me, because it was here first, was VRBO. Are you getting any data from a place like VRBO? Are they any competition to Airbnb at all? Or is the competition here simply between hotel room, Airbnb? Is that the real competition that's going on?
No, I think that there's competition on both sides. We definitely see some strength out of VRBO. I don't think we don't see the level of strength that we're seeing out of Airbnb at the moment. There are other, brands within these larger aggregators like Expedia and Booking. I think there's a HomeAway. There are these other Airbnb-esque names. They're just not as large when it comes to a sample size, and they're not getting as much traction when it comes to just, consumers wanting to talk about them. But they're definitely there, and they're definitely an option that consumers have. I think that Airbnb's saturation is just really large. And, one thing that we're noting too is it's not just this demand increase for Airbnb, but we're also seeing some sentiment improvements. I like this hotel comparison because this kind of showcases that in general, this traditional hotel, there is a value proponent of going to a hotel and having services, and some people like that. So I think it's good to see that, Airbnb hasn't necessarily caught up. It's not necessarily operating at the level of the, traditional hotel industry, but we have seen improvements, whereas previously people would talk about maybe hidden fees and things of that nature. It looks like they're starting to improve on some of those things because, anytime you see happiness improve 4 points alongside an uptick in demand mentions, that's pretty rare, at least in our data.
Yeah, and let's get this right, guys. It's Vrbo. It's not VRBO anymore. They pronounce it Vrbo. That is the term now. But Expedia owns them, Megan. So they're kind of folded into that company, and Expedia and Booking, they've been doing really well. And a lot of Airbnb, as far as numbers go, they're beating estimates and numbers that they had in 2019 at the height of their expansion here. But when you look at these companies, I noticed on the splatter chart that the positive mentions are lower for Airbnb, and that sticks out to me because the last couple times I tried to book Airbnbs, I ended up not going with them because the fees were ridiculous, and then I just ended up getting a nice hotel room for about the same price. I just didn't want to pay all the fees. Is that why you're seeing a little bit less of positive sentiment compared to the hotels?
Yeah, that, you're not alone. I think a lot of people start to go through the process and then they realize that by the time they're booking, their total cost is doubled versus what the, listed price per night stay was, what they anticipated that they thought that was going to cost. So I think that, that is one area, as well as just the service offerings that traditional hotels provide that Airbnb doesn't. A lot of times when you go stay in an Airbnb, you still have to, strip your sheets and, get your towels together. You're doing a little bit more of the maintenance that you don't necessarily have to do at these traditional hotels. So that gap, I think, is to be expected, but Airbnb is starting to close the gap. So I think that that's a good sign. Another value prop that Airbnb offers, just, from an anecdotal perspective, last weekend I stayed in a tree house via Airbnb. I don't know that any of the hotel names on that scatter plot would have had that type of a, exotic offering for someone. So I think that that's one area that Airbnb has previously thrived, is in these, non-urban areas and unique dwellings, unique experiences, and even in these long-term stays. That's another macro trend that we see start to propel or supporting Airbnb demand, is that a lot of consumers are able to continue to work remotely. And so a lot of people are saying, okay, well, I'd rather work remotely from this amazing location in this, somewhere that feels like a home to me. But whenever I'm not working, I can go, hang out at the beach afterward or something like that. So this is just one of those instances where, I think whenever you look overall, Airbnb shares are trading down about 15% year to date, but we're seeing, definite improvement in consumer demand. So this is one of those instances where we think maybe the market may be undervaluing Airbnb, and so it's definitely on our radar.
Kev, did you have another question?
Yeah, Megan, first and foremost, boy, Megan, I didn't peg you for a treehouse girl. Very interesting turn of events here. I've got to change my whole scouting report on you going forward. Megan Brantley, treehouse girl. Interesting take. Now, here's my question, Megan. The size of Airbnb on your plot here, they don't own anything, right? They don't own real estate like Hilton and Marriott and Hyatt does. How can this company be so big, so much bigger than these other hotel chains when they don't own anything, Megan? How are you getting to that circle being so big on your plot?
I think a lot of it has to do with, just the way consumers mention things. A lot of times, if you're booking a hotel, you might just talk about booking a hotel. You may not necessarily mention the hotel specifically, but if you're staying at an Airbnb, that's somewhat of a different, a unique experience. So now Airbnb has almost become genericized in a way that Uber has as well. So I think that has to do a little bit with the volume that you see there. And also just because, Airbnb is a relatively new concept. I know it's been around for a couple of years now, but who would have thought a decade ago that, we would be signing up to stay in other people's homes that was, operated by this middleman of Airbnb. I think that there's still that novelty that consumers are talking about, even though it's become more mainstream, certainly in the last couple of years. But I know obviously Airbnb isn't reporting earnings this week, but just to give scale, we still track those scores. So if Airbnb were to be reporting earnings this week, it would have a score of about 65. And so that's pretty significant. I think the closest hotel on that list that we're tracking, we have Hilton. Hilton would score about a plus 25. So that's a huge discrepancy, at least in our score. And this is just one of those things where we think this is definitely one to watch, or at least one to put on your radar, because we're seeing a lot of consumer momentum.
All right, great stuff here. So based on that first chart that you have on consumer purchase intent, and where the stock is, pretty positive here on Airbnb. All right, great stuff as always, Megan. Have a great weekend.
Yeah, thanks, guys. You too.
All right, that's Megan Brantley, the Vice President of Research at Likefolio, joining us, giving us the positive sentiment data on Airbnb. Now, Kevin, based on that, how are we going to look at an example trade here in Airbnb?
Yeah, well, the good news is we have really positive data. A 65, Tom. I haven't heard very many higher than a 65 out of Likefolio. That's a pretty solid number there. So when I think of this, I still, though, in the world that we find ourselves in, you've got to give yourself a little room. So, Tom, here's what I did. I went to the trade tab and I looked, and what can get me down to this 130 level? Look at this 130 level, how many times it's touched down there and recovered from that 130. That's kind of the basis of some of my trade here, the firmness down around 130. So what I did, Tom, I went, what gives me about $15 or $16 on the low side? And there it is right there. I've got 2 weeks out, March 25th or April 1st, either one. So here's what I did. I went to the March 25th. When in doubt, always go closer to expiration. I sold 2 of the 130, 125 put verticals, Tom. Now that's out to March 25th, and it's significantly lower than where we are now, right? And then I went the other way and did a 1-lot call calendar with the March 18th to the April 14th. So gave myself a little time. I didn't do the tight one where we might get this for a credit. I wanted a little time, Tom, to be able to extend duration and let the world that we live in right now play out. So I did a little short-term put vertical with a longer-term call calendar, Tom. I'm paying about 330, and if you see that peak that we have, it spreads way out, right? My parameters here for the short put vertical and the call calendar are wide, Tom. So I found a place that I like on the downside for my short put vertical, and that's the 130 level. And then if you look at the 50-day moving average, the 200-day moving average, right around 160, Tom. So I've targeted the moving averages and that big level of support down below, Tom.
All right, so just looking at this, Kevin, where you're buying one of the 160 call calendar, buying the April monthly 160 call, selling the March monthly, which expires in 7 days, the 160 call, and then against it, you're selling 2 put verticals on the 130, 125 short in the March 25th weekly series. Now, if you're paying her roughly about $3.30, that's going to be your risk on the trade. The cost on the trade and the risk is going to be what you pay on this, with the apex of profitability being up near that 160 strike, Kev. And you're also, basically, you're using a short-term put vertical to offset some of the costs on the month-wide or 4-week-wide call calendar to the upside. Great way to look at that. But now, if you look at that, Kev, because of the short put verticals, you've got risk on the downside, right? Below that basically break-evens point here, you're going to be looking at about $145.50 is going to be your break-even on the downside. But because you're doing that call calendar and there's going to be risk on the upside also. So above 182, you've also got risk, but that's substantially higher. But you do have risk on both sides of this trade. So typically on a lot of those trades, Kevin will set up this way that maybe there won't be risk on one side of it, but there is risk far above where the current share price of Airbnb is. It's 4 legs, so you've got some transaction costs, no commissions on this, but this definitely takes advantage of what Likefolio laid out for us as far as their sentiment data goes. Now, whether that'll equate to the stock rising, we don't know, but the stock is definitely underperforming their data. All right. Great stuff, as always, Kevin, on this example trade in Airbnb. But coming up after the break, we're going to take a look at Netflix, which is now down 40% this year. Fast Market will be right back after this short break.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com to all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
If you have questions about retirement planning, then you don't want to miss Investor Education Day hosted by TD Ameritrade. It's a full day of free insights from TD Ameritrade education coaches and experts who can tell you all about honing your retirement strategies. And the best part, it's all online. So technically, you can enjoy the webcast from the comfort of your retirement pants, also known as sweatpants. Register for Investor Education Day at tdameritrade.com/education day.
Ben Lichtenstein here with your TD Ameritrade Network Futures Market Update. Stocks and stock index futures products continue to point lower off the overnight highs. The ES back to yesterday's low, 100 points off the spike we saw ahead of the cash open in reaction to recent comments from Russia's President Vladimir Putin, who said there has been certain positive shifts in the diplomatic talks with Ukraine. The NASDAQ and the Russell are leading the move lower today, while the Dow is actually fractionally higher. Large caps are, well, holding above unchanged territory. McDonald's and Cat have been leading today. They're both up around 2%. The dollar's getting a lift this morning to a 5-year high versus the yen, which if lower today, it's the 5th in a row, with U.S. Treasury yields inching up some this week, and U.S. government data showing CPI inflation year over year reached 7.9% in the U.S. last month. The greenback's above 99. Weighing on the yen, disappointing data out of Japan. Household spending fell 1.2% in January. That was the 6th drop in the past 9 months, fueling expectations the world's third largest economy will contract this quarter. Also supporting the dollar, the euro this week back below 110 after the ECB left rates unchanged, but they did announce plans to taper asset purchases. It did little to provide support. Keep in mind, next week the Fed's expected to announce an increase of 25 basis points. Appears this is also providing a bit of a tailwind. The dollar's up above 99, currently trading up about 0.5%. This has been your TD Ameritrade Network Futures Market Update. Now back to Fast Market with Tom White and Kevin Hinks.
Welcome back to Fast Market. I'm Tom White, joined by Kevin Hinks. Kevin, we got to readdress that Airbnb example trade that we just looked at. I said the risk was $330 what you paid, but that's not accurate because we got two short verticals in there built in. So total risk on this would be $1,300, and that's all the way down below that 120, 110 level on the downside. So make sure it's still risk defined, but you do have more risk than previously stated. So good look at the example trade there on that. That wraps up that one, Kev. But now let's move over to discussion on Netflix. The stock's down over 40% so far this year. It's pulled back nearly 50% from those all-time highs that we saw in November, above $700 a share. Now, this was all based on the fact that after that last earnings report, Kevin, this thing got hammered because they don't, investors and traders in the street don't like lower guidance out of this company, and that's what we saw.
You know, it's interesting, Tom. They're making money, right? It's not like they're not profitable, but they're not growing like they were, and they're spending a lot of money on new shows and new content, but they're doing everything well. You know, I think you read the same article that I did about this analyst who came out and said, this company, Netflix, is going to turn out to be a low growth, high profitability company, right? But it's not going to grow like it was earlier. And I think that's pretty interesting because, well, at the end of the day, you want them to make money, right? And I think their ability to bring out new programming has been pretty successful, right? They are still dominating streaming, right, over all these other competitors. So I think they still have a good story, but everyone should get used to probably lower growth, lower PE, still extremely profitable though, but a different makeup of what Netflix is going forward, Tom.
Yeah, that's true, Kev. And if you look at it, as of December of 2021, they had about 222 million subscribers. And I think typically in Q1, they expect anywhere about 8 million subscriber ads. And I think the company came out and, estimated for about 2 to 2.5 million ads is what they expect. So that's really down below what we've seen historically on Q1 numbers. So that's going to be a headwind moving forward. Now, the company reports earnings in the middle to late April, right, for this company. So you've got some time, before the next earnings event to see if that comes, and see if the company lowballed the expectations moving forward. Because if you see the ramp up in their spend on content, $8.11 billion in 2020, $17.7 billion in spending in 2021. So significant jumps. But then also, if you look at their operating profit margin expanded from 2016 to 2021 from 4.3% all the way up to 21%. So that's pretty impressive numbers there as far as growth goes. But it's always with Netflix, Kevin, a discussion about saturation, right? Here in the U.S., maybe saturation, but a lot of their growth is coming from overseas. And as we reopen, will that potentially hurt subscriber growth? So I wanted to look at something here in April monthly cycle, Kevin. So April 14th, monthly options. Now, the stock has pulled back even more from when I looked at this earlier. So I wanted to look at a short put vertical, but I'm going to use the 330 put that I'm going to sell, Kev, in the April monthly, so 34 days till expiration, and then buy the 310 puts, so creating a short neutral to bullish $20 wide, so a little bit more aggressive, $20 wide put vertical. If I can collect roughly about $5 and maybe 40 cents, I think that's where it's trading, right? I'm going to have $14.60 at risk per spread. Now, I've got a cushion to the downside with a probability on that short 330 strike of about 60%. Kevin, your take here on maybe a little bit more aggressive, but a $20 wide short put vertical in Netflix.
Yeah, it's a big boy, right?
Yeah.
How do you collect more premium on a trade like this? Well, you could move that short strike closer to at the money, or you can widen out the spreads, right? This is really, in many ways, Tom, a cash secured put with a wing $20 below just to make sure that your margin is within reason, because a cash secured put on a $340 stock, almost $350, is not cheap, right? So, but this is a nice big boy short put vertical. It's still doing everything that we talk about in our three pillars. It's risk defined, although the risk is a little more. It's high probability, and it's collecting theta. So it's still doing all the things. What did you change here, Tom, as opposed to the normal in this paper money trade? You just widened out your strikes to create a little more net credit, Tom.
Right, and implied volatility is just below 52-week highs, Kev. The RSI on a technical basis getting close to the 30 level, which is oversold. But I looked at this based on the fact that the stock bottomed out around 340 and bounced over the last few sessions. It did almost test that 350 level when it pulled back after earnings also. So maybe a little bit of support. You've got your 50-day that came below the 200-day. So the death cross has been in effect for the last month or so. But just running through that example trade again, if you think there's going to be support, this may be one way that you can look at potential strategies in here. Now, if you're more neutral to bearish on this, maybe in this high implied volatility environment, maybe you can sell an out-of-the-money call vertical with a higher probability of success also. It's based on what your assumption is. But as I mentioned, if you collect roughly a 540 credit on that, Kev, your break-even point is going to be that credit that you collected minus that short 330 strike. So you're going to be at 324.60 as your break-even point. The most you can make is what you sold this vertical for, and that's the whole idea, to stay above that break-even point. As I mentioned, about $14.60 in risk on that. Kevin, just wrap it up for us real quick on this example trade in Netflix.
Collecting theta, and think about this. This is just a put vertical in a wider strikes that's collecting more premium. All the parameters stay the same, just a few bigger numbers, Tom.
That's right, and you got 34 days in that example position also, so you've got some duration, and you avoid earnings event because earnings is the next weekly series. All right, Kev, that's going to do it for us today here on Fast Market, but stick around right here on the TD Ameritrade Network as Next Gen Investing is coming up with Alex Coffey and Jenny Horn. Have a great weekend.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the Income Investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Happy Friday, good afternoon, and welcome to Next Gen Investing. I'm Alex Coffey alongside Jenny Horn. Jenny, we were just talking about it. I don't know if it's the market action. I don't know if it's kind of the sluggish weather we've gotten, but I am ready for the weekend.
I am too, and we got some snow on the ground here in Chicago, and it was about 23 degrees when I was getting to work this morning, and it's coming to that point in the season where I'm just a little bit over the snow. So I do think this has been a long and brutal week, and we actually saw the 4 major indices higher this morning. The Dow is clinging onto those gains, but weakness really in the 3 others, Alex.
Yeah, all things considered, though, for a Friday thus far, it's been a really, really quiet day. I think you see that in volatility lower, but down 13 right now in the S&Ps, down a little bit over 130 in the NASDAQ. All things considered, I know the NASDAQ a little bit weaker today, but it's a pretty quiet day. Still 3 hours left, though. So, Jenny, in those 3 hours, a lot can happen. We've seen that throughout the year of 2022.
We definitely have, and I think the markets even seem maybe a little bit tired today, Alex, as they have been all over the place this week. But as always, we will focus on the micro moves today, and there are a lot of them, some earnings reactions as well. So we will go through our upvote and downvote segment. Following that, we will chart and trade our upvotes, and our FOMO discussion today is around NEO's weakness really this week, but also so far year to date, especially after they listed on the Hong Kong Stock Exchange yesterday. Then we will preview Lennar ahead of their earnings report next week and discuss some mixed price action in the home builders this week. And last but not least, we will look at Vail Resorts, who also will report next week, Monday after market close.
A lot of fun names, a lot of household names here, things that we know well, things like Peloton, Amazon on the list, Vail. That'll be a fun one here as we head into the weekend. I know you're sick of the snow, but I think those who go to Vail are seeking the snow, oftentimes looking to go skiing and snowboarding and the likes. But Jenny, upvote, downvote, as always, not endorsements or recommendations.
Okay, and Vail is a different kind of snow. That's like, skiing or snowboarding snow. It's a little bit different than like alley snow, like getting out of my apartment, trudging through snow. I'm over that. But our first name today is Amazon. We actually obviously had news that came out late Wednesday that this company announced a stock split, and we have seen some analysts pour into the name since then. Deutsche Bank began coverage on several big tech names, including Amazon, but saying that there is still optimism behind these stocks. He initiated Amazon with a buy rating and a $4,100 price target, which implies nearly 40% upside to its closing price on Thursday. He said he believes the market is underappreciating upside associated with retail revenue, multi-channel grocery share gains, and the AWS revenue implication of the backlog additions that the company added back in 2020 as well as 2021. Plus, of obviously the stock split news on Wednesday, we also got news of a buyback plan, which really the company hasn't repurchased any shares since 2012. They also hadn't split their shares since 1999. So I think that Amazon is sort of trying to undergo maybe a transformation. I think that perception of this, they were sort of the golden child of Wall Street, that has faded. I think that they're trying to get back in a lot of investors' good graces, Alex.
Yeah, no, I think that's well said. It's a downvote today, although I will say that I'm excited to hear about the split, not because splits mean the stock's going to go higher, but rather because it makes it a lot more accessible. It's going to open up the strategy book for those with a little bit smaller sized accounts, those who want to be a little bit more capital efficient. Right now, names like Amazon, Alphabet, even Tesla to some extent, with those big stock prices, Jenny, they're just not the most accessible names to the next generation of investors. And going the way of Alphabet, going the stock split route, 20 for 1, It's going to be interesting. I'm excited for that, just like I said, because it kind of puts it back on the list and opens up that strategy book a little bit.
Yeah, that's a really good point, because I think Amazon is notoriously at that price level where it's just like, who could afford to buy several shares of this company with, this $4,100 price target? This is not a cheap stock, of course, and it's sort of notorious for that. But now our next name is DocuSign, seeing a pretty sizable move lower following their fourth quarter earnings, which were released yesterday afternoon. And first of all, Alex, I have to ask you a question, because a guest said on Nicole's show that he thought DocuSign was a verb, almost used as Google. Then Oliver discussed this with his panel yesterday and then mentioned it again on Morning Trade Live. So I'm continuing. This is the fourth show now we'll be discussing this on the TD Ameritrade Network. Do you think DocuSign is used as a verb?
I do not, but I think it's the most recognizable, if not the only recognizable name within its space. So I don't say I DocuSigned my lease agreement, but I might use DocuSign to sign my lease agreement. So I think it's a little bit different there, but maybe it's the most recognizable name in its space. The same way Amazon. I don't say I Amazon something, but I order it on Amazon. So I think it's still a very important key piece. It's not a verb, though, in my opinion.
That was a very, very good way to answer that question, Alex. But obviously, we are seeing some move lower today, down over 23%. Following those reports, they actually reported inline profit that did rise year over year on revenue that beat forecasts, but the CEO mentioned sales challenges going forward. Selling to more existing clients may be the issue here, he highlighted. We also got a note from Wedbush that said DocuSign will continue to see a decline in its sales growth for fiscal first quarter as well as fiscal 2023 as outlook trailed expectations. But most troubling to Wedbush is that management, they said, does not fully have their arms around the sales execution and headwinds in the field, which means further disappointment could be expected in the horizon. So disappointing guidance weighing on these shares today. And this was a stock that you can remember it tripled in 2020, Alex.
Yeah, and this is a great example of weakness can continue to get weaker. And this stock is under pressure. It has been under pressure. Earnings have not been kind to it. All that being said, I think it's a very interesting conversation, and for that reason, an upvote.
Yeah, I think definitely worth exploring more into, especially because now this verb conversation has garnered our attention for 4 different shows. So we will discuss this name a little bit further, but our next name now is AT&T, who issued guidance for its expected performance following its spinoff of Warner Media. They reiterated their guidance for 2022, excluding this Warner Media segment, and I saw an analyst report that said AT&T, the life after Hollywood, which I thought was very interesting. They said they will focus more on their 5G investments as well as their fiber optic lines, and they will cut actually their network of copper lines, which is their legacy landline telephone networks, in half by 2025, meaning about 75% of their customers will now be using 5G as well as fiber optics. They also expect low single-digit revenue growth, up from about $118 billion in 2021, and they said growth will be driven by a 3% expansion in these wireless revenues and 6% in broadband revenues. They also really said their free cash flow will be in the $20 billion range for 2023. Something that was interesting about this report, as they did give really so many different numbers, is that they are actually changing the way that they report free cash flow in response to investor feedback, and they are trying to make this more consistent with some of their industry peers. Now, stock isn't really reacting in a huge way, up slightly, but markets are lower, and I do think that these numbers and any sort of clarification on the future is always something that's welcomed by the street.
Yeah, it's an interesting one. Obviously it's green today with the market lower, but you do have the Dow in green territory, so it's nice to see that. But all things considered, there's just not a lot of volatility in this name. It's kind of a boring conversation. I hate to say that. AT&T, one of the kind of blue chip dividend paying stocks that finds its way into so many retirement accounts that are looking for income related strategies over time, but from a next-gen standpoint, not the most exciting one, and solely for that reason, a downvote.
I completely agree, and AT&T service does not work very well in this building that we work in, so I have a bone to pick forevermore with AT&T, why we can't get service. Currently where we're standing is beyond me. But now our next name is Peloton. Now Peloton had some news that actually this new CEO is making pretty serious moves to overhaul their pricing strategy with a new turnaround effort. Starting today, actually, they will begin testing a new pricing system where where customers will pay a single monthly fee that covers both the stationary bike as well as their monthly subscription cost. And if you cancel, Peloton will take back the bike without charge. And we know this pricing strategy will kick off in select cities, some of those being in Texas, Florida, Minnesota, as well as the city of Denver. But the bike subscription combo will range between $60 to $100 a month, which all of a sudden has me thinking, Alex, should I buy a Peloton? Is this the most affordable way to get into this company? It seems like, at least at this lower price point, it possibly is. So that's obviously a benefit for a company that has seen such selling, such weakness over the last several months. But Cowen did reiterate their outperform rating on Peloton today after this new pricing model announcement, saying Peloton is actually still in the early innings of long-term transition into this connected fitness space. Also saying that with this new pricing model, customers will sign up in store or at studios, which is where the company sort of sells the bulk of their hardware. So they seem to be sort of, I would say, not overwhelmingly positive or negative, just sort of mixed on this company, Alex. But obviously Peloton is one that always captures our attention as it has made pretty big moves to the downside over the last year.
I think that's an understatement to say the least, but a kind of a tie-in theme to the DocuSign for two reasons. I didn't anticipate one of them, but I would argue Peloton's more of a verb than DocuSign.
I agree.
Two, this is another example of weakness getting weaker, and it's very difficult to catch a falling knife, but we'll have the conversation nonetheless. Another very interesting name, although I will say on the record, I probably wouldn't say I Pelotoned either, but maybe I'd be more likely to say that than I DocuSigned.
I completely agree. Maybe just because you'd be more frequently Pelotoning. How often are you DocuSigning? But to tell us more on both DocuSign and Peloton is Rick Ducat, TD Ameritrade Network contributor. Rick, first things first, got to get this question out there. Do you think DocuSign is a verb?
I've used DocuSign a grand total of once, so I'm going to say no. I also looked up competitors for this one, and I didn't recognize any of these names. I don't think it's quite common enough yet. But looking at the chart, it's kind of an interesting situation we've got here because we're down near some old lows from March 2021, and it's kind of just on the verge of falling below this point. So we're down 69% since our last earnings event on December 2nd, and there we go. And implied volatility is falling off quite a bit. We're at 168,000 options traded today, 57% being puts. In terms of open interest, the call side, 73, 75, and 80 are notable strikes. Puts are 55, 70, and 75.
Nice one there, Rick, on DocuSign. Hey, got a fun fact for you guys. So we're having this conversation around verbs. If you asked the primary kind of most notable PGA Tour golfers if they golf or if they play golf, do you know that they would say they play golf? They don't consider golf a verb. It's a noun. It's the name of the game. It's not the activity. So you play golf, but nonetheless, Peloton, another active activity that you can do, but you do it inside most likely.
Well, most of the activity on the chart has been to the downside here lately. So, it's actually a pretty similar situation to the chart we were just looking at. Older support coming into play, a longer-term chart we've got to look at to find something useful to go off of. Also down more than 60% since our November 4th earnings. Looking at the options market today, about 47,000 options traded with a slight bias toward puts. The biggest open interest strikes for next week on the call side, 30, 31, 35, and 40. To the put side, 15, 20, 25, and 30.
You know, Rick, it's companies like Peloton I find so interesting because not only are they getting hit by the broader market weakness, but they also are getting hit by their own set of woes. So I think the technicals are so important in Peloton as they sort of are getting hit by two different ends of the spectrum here. But that does it for this segment. Now, coming up next, Rick will be sticking around. We'll be diving more into the technicals on both DocuSign as well as Peloton. Alex and I and Next Gen will be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
Minutes after the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Welcome back to Next Gen Investing. I'm Alex Coffey alongside Jenny Horn. We're still joined as well by TD Ameritrade Network contributor Rick Ducat. Here on this Friday afternoon, we got the battle of the maybe verbs. We got DocuSign and Peloton. Jenny, you got me thinking about this. Again, I'm gonna put it out there. They're not. They're neither one of them are verbs, but Peloton, again, final answer, more so than DocuSign.
I think it also a lot has to do with how much, the frequency at which you'd be using a service. Like, you wouldn't be Pelotoning multiple times a day. I mean, if you were, more power to you. And you wouldn't be using DocuSign so frequently. I'm in the same camp as Rick. I think I've used DocuSign about once. Although I did just use it to re-sign my lease, which it was a great tool. I do have to say that in some respect to DocuSign, it is a very easy, user-friendly tool. But Rick, it is no secret DocuSign is getting absolutely crushed today. It is down over 20% on the day. But more notably than that, this was a name that was a high flyer back in 2020. Its price nearly tripled.
Yeah, it's been a really notable, really severe slide downward for this name, and it could keep going right now. I mean, we're trending lower highs, lower lows, especially today after earnings, are really getting taken to the woodshed here, and it's one important thing I wanted to point out is that I put up our Bollinger Band study on this. That's our channel that goes around the price based on a 20-day simple moving average, and then simply 2 standard deviations away from that point. So today it looks like we're on pace to close below that lower Bollinger Band. This is typically viewed as a bearish sign because we're reaching extreme prices to the downside here. And that's really what studies like this tell us. They compare our previous price action to itself to give us an idea of what's extreme versus fair value. So right now, granted, we did have this event that was a catalyst for this move, but it seems like the door to further downside is being open right now here because we're now within striking distance of those old lows near 65 that I had on our first chart. So that could be an area where you might say, okay, this is getting a little too beaten up. This could be a point of support, or you could view it as the candidate for a possible breakout to the downside further. Looking at point B next, this is our new point of resistance. This is our ceiling, so to speak, because this was the old lows from a few weeks ago, right around 100. That's where prices kind of bottomed out. And that would be a point where traders probably would be interested to see if we could retake that level. Old support becomes new resistance and vice versa. So that would be a potential upside target to watch. Finally, beyond that, we've got the 155 level. That's the top. That's the area where prices first gapped down after our last earnings event that we saw before. It's a bit of a far cry from this point now, but oftentimes these levels get retested. So it could happen, but you know, it's not looking too likely today, especially because we're in the oversold area on that RSI near point C. Once again, further evidence of bearish activity.
Okay, Rick, so I swear I'm going to stop talking about this after I get my final comment on the Verb conversation. I have found a few. Ubered, FaceTimed, or Skyped is another one. Photoshopped. So these are all, I think, common companies that can be used as verbs. DocuSign still is not, but that does not take away from the brutalness of the chart that is really the last year, but also just the intraday chart now. Now, Alex, say we're looking at this name and we think, wow, shares are getting pretty beat up today, to say the very least. Taken to the woodshed is actually Rick's term, which I loved, down over 20%. So you think potentially, say you think that the shares could recover some from here, given, of course, the sell-off. How would you trade this name?
So a couple things. First off, you're going to see a theme throughout our example trade illustrations today. I'm going all the way back to basics. None of them are going to be too technically involved. They're going to be very kind of simple strategies. So that's first off. Second off, I commend those who trade that way if they haven't already tried to do so in DocuSign, because there's been several times along this way that if you were someone who likes to buy into weakness, you probably saw weakness. So say you have not. You're looking at this, it's down another 20%. It's gone from 314 now back to levels that we haven't seen since basically the pandemic bottom. And so this is incredible, the amount of damage that has been done here. What we're going to look at, this is an outsized risk trade in total risk. So keep that in mind, Jenny, but it's a simple trade, and it's one that has a high probability of success, but is only one that you would implement if you were willing to potentially become a shareholder down the line. We're selling the cash secured put. This stock has gotten crushed to the downside. Rick highlighted some levels along the way that could be critical if it continues to fall, 65 being the notable one that he mentioned to the downside. So we centered in on that strike, looking to sell the April 65 put for a $4 credit. That brings our break even to $61. Of course, the total risk on this trade is $6,100. But Jenny, that only would happen if it went all the way to zero. I'm not going to say that that's impossible. It's certainly possible, but the likelihood is probably not high. That being said, from 61 onward, it is penny for penny. So if this stock went to 50, for example, you would be out still a substantial amount. It'd be close to $1,100. So keep in mind, you have to have a decent sense of risk tolerance here, a willingness to set aside that much capital, as it's going to be a little bit more capital intensive. But again, this is a way that some investors would use options to potentially acquire shares at a lower price. Say this were to continue to sell off below 65, we faced assignment. We would buy 100 shares, effectively a stock price of 61. If it just stayed above this level, never tested that, we know our credit is the max possible profit, so we can stand to make $4. I want to show one more thing here on the chart, if we could. Pulling the platform back up, just to show kind of a way to think about things. First off, this gold dashed line represents our break-even point. So you can see it gets back to a level that this stock spent a lot of time around. But you can just see the carnage that's been done here. So if you were just simply looking at this from a pot odds standpoint, well, we know that there's a lower bound. This can only go to zero. So you got $72 in risk. Well, this stock was $314. Who knows if it'll ever get there again? But that's a lot more. That's almost $250 in upside potential. Or even just the beginning of this year, you can see it's been as high as 150. So that's something to think about. Again, I don't know if this stock's going to go higher or lower, but if you were looking for a way to potentially get long this name, that is one way that many seasoned investors and traders would look to utilize this heightened implied volatility to buy into some weakness here in a name that's gotten absolutely pummeled.
And of course, if you have this neutral to bullish stance, you'd obviously be looking to capitalize on that, upside momentum, while also considering the $6,100 in risk, as you mentioned, is something to keep in mind. However, that would be the event if the stock went to no value. So that is, I would say, unlikely, but of course, anything could happen. But now we're looking at Peloton, Rick, and Peloton, a name that is no stranger to the headlines. It feels like this company cannot catch a break. I mean, they've tumbled 10% this week, but more notably over the last year, they have fallen substantially from those highs.
Yeah, similar looking chart to what we just saw. Two stocks that are having a pronounced downward trend, rough earnings that they had during their past event here. But the movement in this one kind of reminds me of a stationary exercise bike here. We're moving around a bit. We're not really gaining or losing any ground. It's just kind of spinning its wheels, so to speak. So starting off with point A, what was interesting to me about this chart and this setup that we have here with our Bollinger Bands is these help us show how range-bound the price has been lately. We've got these channels based on our moving average line that are just trending completely sideways here, and they're also narrowing. They're getting closer together, which tells us that the volatility in this name is also shrinking. This is very important because a lot of times low volatility can be a sign of impending high volatility. Traders are getting increasingly committed to their trades. The lines in the sand continue to be drawn farther and farther in terms of price. So all it needs is kind of maybe a little push to one side or the other to experience a larger breakout. But this 18 level that we highlighted on our first chart, this is an important area to the downside. And really the actual lows were just a bit below that. I just chose to use a whole number for ease of reference and for selecting strike prices and such. But looking at point B, that would be, if point A was our floor, point B would be our ceiling near 40. This is where prices topped out a little bit. And from that recent top that we saw, we drew a trend line trending downward along price. That would be an important level as well for price to break above. And that would be right around the 23 level or so, because that would mean that this short-term downtrend that we're in could be getting broken. We're not seeing that that's happening quite yet today, though, however. So one final thing I wanted to point out, too, if we do get a break to the downside, watch that RSI, because if a move into the oversold area would be the case for further bearishness, as we saw in our previous chart. It's really, this is kind of almost like the setup to the chart we were just looking at before the big move happened.
As always, Rick, thank you so much for joining us on this Friday. Have a wonderful weekend. I hope it warms up here in Chicago. That's Rick Ducat, TD Ameritrade Network contributor. So, Alex, say, obviously, I admit I've been so wrong about this name, but we did get some positive news from them. So I'm going to be an optimist one last time and say a pricing revamp is something that I think is a very good sign for this company. And clearly we saw from Cowen today that the analyst community is also echoing some positive sentiment.
And sometimes, Jenny, you know, the pessimism, the bad news, it just piles on and piles on and piles on to the point where sentiment is so bad that, you know, at some point it just can't get a whole lot worse. That's not to say that the stock price can't go lower, but there's not a ton of optimism surrounding Peloton. And, I believe it was Warren Buffett who said to, be greedy when others are fearful and be fearful when others are greedy. And I think Peloton illustrates that perfectly, as you saw the tremendous run higher. Everyone wanted Peloton, and now so many want to avoid this company. There's just a tremendous amount of fear. All right, so in families, especially those who have competitive siblings, maybe they have Peloton and they're on Peloton. There's oftentimes the older sibling when they're growing up. They're just more athletic because they're bigger, they're farther along in life. They overshadow the younger sibling. But ultimately, sometimes they end up both being good or great at a particular thing. In option strategies, the cash secured put, while great, is oftentimes overshadowed by this strategy, the covered call. But in theory, they're really the exact same strategy. It's just, for many, it's an easier concept to grasp because you start with the 100 shares and then you sell the call as opposed to starting with nothing and just selling the put for the exact same risk profile. So what we're doing here, again, I promise we're going to keep it simple. We're going to stick to the basics. We're doing that today. Buying the covered stock. The 24 call above that 23 mark that Rick had highlighted for a potential resistance point to the upside, selling that April 24 call against the 100 shares of stock. Whole package, $19.75. The easy thing is that's the break even. We know that to the downside. It's also the total risk for those 100 shares and that one short call, $1,975. Max profit, $425 if it got called away to the upside through 24. But Jenny, this again, the risk is, the entire risk is only going to be felt if the stock were to go to zero. So again, we know how stock works penny for penny. Think of us as buying stock at $19.75, but we do have capped upside. We basically have a locked-in sell price at 24 at that expiration. But keeping it simple here, Jenny, buying the dip in a couple names that have gotten crushed, and we'll see what happens. This is not a recommendation or endorsement of these companies, just using them as an illustration of these strategies.
Right, both two stock replacement strategies, both leaning a little bit bullish. Obviously, you'd have to be comfortable addressing that amount of risk if we saw both of these names move lower, which we always know is a possibility. But two ways to sort of capitalize on some companies that have seen a ton of weakness, not only this week, but over the last several months. But that does it for this segment. Coming up next, we will be talking all things NIO, another name that has seen some sizable weakness as of late. We will dive more into the EV name coming up next.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
90 minutes after the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Welcome back to Next Gen Investing. I'm Alex Coffey alongside my co-host Jenny Horn. Happy Friday. It's time for FOMO Friday here, Jenny. We're talking some NIO, and you know, when we were going through these, I don't even know that it was intentional when we were selecting them, but there's a